नवनाथ बाहेर. So once again, good afternoon to all. I welcome you all to the second day of the Direct Tax Refresher course. And now I request immediate past Secretary of WRC Shweta Jain to please escort today's first speaker, C. Jagdish Punjabi, to the dais. May I request everyone to welcome him with a loud round of applause, please. Jagdish ji, thank you very much for accepting our invitation and for joining us here today to share your valuable knowledge on the most difficult subject of taxation of joint development agreement. So thank you. I also recognize presence of the second speaker, C. Vipin Batavia ji. Vipin ji, welcome. And he is going to cover again the lot of changes which are happening, the ever-changing charitable trust. So thank you, sir, for joining us here. I also want to thank immediate past Secretary Shweta Jain and Regional Council Member Rudesh Pankhania. Rudesh, thank you. And to all of you friends, maybe I'll take a minute or two. I think the direct tax space also is evolving and there is tremendous amount of work which people are doing. And as I see, most organizations these days, especially the multinational and even the India promoter driven organization, want to outsource everything and focus on their core business. And initially, the outsourcing possibly started with some smaller routine areas like claim processing or payroll processing. But now what I see of late the trend, possibly in the last 3 years, I don't know, I could be wrong as well, that the whole tax department also is getting outsourced now. And there are firms like yours and mine who pick up the whole taxation activity and they call it as a managed business service for the organization. And which means that the organization does not have to have a direct tax head with a 40-50 lakh CTC or an indirect tax head and a large team of 4, 5, 6 people, 10 people, and which you could pick it up. You could do the returns, the liability calculation, the input credit sitting from your offices, and you could use any level of resources. And maybe a partner or director, a senior person can look at multiple clients, multiple assignments. And again, it comes as a very good fees. So managed business services on the taxation side, both direct and indirect, more so on the GST is evolving. And when it is outsourced, the firm does everything. So not only filing of returns, but then they support on the opinions, assessments, litigation, multiple of these. The second interesting thing which I am seeing now is again automation, like it is happening everywhere, adoption of technology. I think people have started, people are talking, and people are using some tools for uh, automation tools on the taxation side as well. And especially so when you have a tedious receivable sitting here and then the form 26 years and someone is sitting and doing one-to-one reconciliation, RPA bot can do the reconciliation for you, a 2A, 3B reconciliation, and there are so many other things which are getting reconciled. And again, some analytics type of thing that what is the professional fees and what is the TDS on professional fees and things like that. So people are using technology and I think we should. Of course, the third important aspect remains the litigation. And litigation comes at a little more dollar per hour. The rate per hour is little more on the litigation. But I think still, I may be wrong, but still the highest dollar per hour comes from restructuring. And many restructuring deals again are like removing or demerging one company from some place with a carry forward loss, merging into someone else where there's profit, and people do it. I call them architect of direct tax. They do such beautiful transactions, and they also take care of all the compliances and documentation to ensure that it will get through the taxation and the resulting savings of lots of crores of rupees of taxation. So interesting work being done by organizations, and I'm sure all of you must be aware of, but if not, and if you're not looking at something, you're missing something, you should look at that. With that, let me now request Shweta to introduce our speaker today. Shweta, over to you.
Thank you. Our dignitaries on the dais, all the participants, a very good evening to all of you. And it's really a pleasure for me to introduce such a eminent personality like Mr. Jagdish Punjabi. He is a practicing chartered accountant and practicing mainly in area of direct taxation since 1989. And he has secured a rank in CA inter examinations. He practiced in his, of course, an individual name. He has been a lecturer in accountancy and taxation for a period of 17 years in Ghanshyam Das Saraf Girls College of Commerce and Economics and St. Andrew College of Commerce and Economics. He is a contributor to the featured tribunal news published in the Journal of Bombay Chartered Accountants Society. Also a regular speaker at various seminars all over the country and has also presented paper and authored articles. He has been a guest faculty at the training programs conducted by National Academy of Direct Taxes, Nagpur, and also by Direct Tax Regional Training Institute, Mumbai. So with this brief introduction, I welcome you, sir, at the platform of WIRC, and thank you so much for accepting the invitation. And before handing over charge to you, it is our duty to just welcome you with some small token of appreciation. I request past Chairman Murtaza Kachwala sir to present a memento to him.
Good evening, Mr. Murtuza Kachwala, and my friend, Mr. Batavia. Good evening to one all. It gives me great pleasure to be here on this task, sharing with you my thoughts on taxation of development agreements. What we will do is, over the next 75 minutes or so, which have been allotted to me, we will run through the likely issues which are arising regularly in dealing with the transactions which are entered by way of executing a development agreement. Now, before we get into the taxation issues proper, let us understand what exactly is a development agreement. Development agreement, like any other agreement, is an agreement which has two parties. The parties to the development agreement are the landowner and a builder developer. Generally, what happens is the landowner has land. He does not have either the wherewithal or the finance to develop the land which he owns. On the other hand, the builder developer has the requisite expertise. He has the finances to put on the construction, but he does not have the resources to go and buy land from the landowner. Therefore, development agreement is a sort of a workable model which suits both the landowner as well as the builder developer. Both of them join hands. Now, is it a transfer of land that we are talking of? The answer is yes and no. Why do I say yes and no? The answer is, in the ultimate analysis, at some point in time, there is going to be a transfer of land from the landowner to the society of flat purchasers or to a nominee of a builder developer. But at the moment, when I'm executing a development agreement, it is not a transfer of land, but undoubtedly, it is certainly a transfer of certain rights, most valuable rights, the development potential of the land. Now, what happens in a typical development agreement is that the agreement is executed. And let me first get into what could be the types. Now, as I said, the landowner gives the development potential of the land to the builder developer. He tells him, here is my land parcel. You can develop it. You make the plans. You construct a building thereon. But what am I going to get in return? There could be three options generally. One could be that I, the landlord, receive monetary consideration from the builder developer. This is plain, simple, vanilla development agreement. I am giving you development rights. You are giving me monetary consideration. Taxation will be very simple. I mean, no great thing over here. The second could be that I am interested in the upside in real estate. The general thinking is real estate always keeps rising. I don't know whether it's a fact or it's a myth, but whatever it is, we do carry that impression that prices are always rising. Therefore, I feel that no, the developer should not make all the money. I should also share, right? Therefore, what we enter into is possibly an area sharing agreement. Now, in an area sharing agreement, what happens is that I tell the developer that you come and construct a building on this plot of land which belongs to me. You construct a building, let's say, of 10,000 square feet. You retain 4,000, you give me 6,000. Therefore, what is happening is that when the building will be constructed, the cost of construction will be incurred by the builder developer. The landowner has permitted the builder developer to exploit the development potential of the land which he owns, and on the building, out of the building constructed of 10,000 square feet, the builder developer will hand over 6,000 square feet of constructed area to the landlord. He will retain for himself 4,000 square feet. That 4,000 square feet, he is going to sell in the market. He is going to deal with it the way he wants to deal with it. Out of that sale consideration, he is going to make his profit. The ratio could be 60-40, it could be vice versa also, depending on which is the locality in which your land is situated. So there is going to be a break even or a calculation between the land cost and the construction cost. Now, therefore, what have I parted with? Me, the landlord, what have I parted with? According to me, what I've parted with is the 40% interest in the land, because 60% flats are coming back to me. Therefore, I have retained development potential to the extent of 60%. What have I got in return? I have parted with 40% of the development potential of my land. And ultimately, in the ultimate analysis, I will part with 40% of the land, undivided interest in the land. But what have I received? I have received construction cost of 60% of the area which is allocated to me. So in the newly constructed building, I will be entitled to 60% of the flats so constructed. Now, those 60% of the flats comprise of land plus the construction cost. Land was mine only. I have transferred only 40%. Therefore, what I have received as consideration for transferring 40% development potential is the construction cost of 60%. Is this one way, right? So this is an area sharing agreement. Then the third type could be a revenue sharing agreement. So in revenue sharing agreement, what we do is the landlord tells the builder developer, you use the maximum potential of the land, construct the building, you sell the building, but every flat which you sell, every foot which you sell, let us share the sale consideration. So we are going to share not the profits of the project, but we are going to share the gross revenue. So the top line is being shared. Again, the ratio could be 60-40, could be 40-60, could be what the parties commercially decide. So basically, we're talking of three types of development agreements: plain, simple, vanilla development agreement, where monetary consideration, monetary amounts are the consideration for transfer of development potential. The second is area sharing agreement, which could be only area sharing, or it could be area sharing plus some amount of money. I may say that, no, I need some money as well, right? So I may have 60%. Instead of 60%, I may say, give me 50% of the area and also give me 10 crore of rupees or give me 5 crore of rupees. So those are the commercials. And the third could be a revenue sharing agreement, where we share the top line or the gross sale realization of the projects. Now, let's also keep in mind, before we proceed further, that capital gains are computed under section 45 subsection 1. That's the charging section. However, we also have on the statute 45(5)(a). Now 45(5)(a) has been introduced effective assessment year 18-19. 45(5)(a) applies, 45(5)(a) is non-obstante 45(1). Therefore, to the extent there is a contradiction between 45(1) and 45(5)(a), it is 45(5)(a) which is going to prevail over the provisions of 45(1). 45(5)(a), like 45(1), is a charging provision. 45(5)(a) is also a charging provision. Now, why was 45(5)(a) introduced? Legislature says that we find there is a lot of controversy on the year of transfer, which is correct. And therefore, to simplify things, to make life easier, we are giving you 45(5)(a). So what's the objective? The objective is to resolve the controversy as regards the year of transfer. Because when you enter into a development agreement, question arises that I am required to pay capital gains. In which year? Which is the year of transfer in which I must compute an offer for taxation capital gains? It was so happening that the year of transfer was different from the year of receipt of consideration. Therefore, landowner faced a difficulty. He says capital gain is arising in year 1, consideration is accruing to me in year 4 or year 5. How am I supposed to pay taxes? How am I expected to pay taxes? So legislature brought in 45(5)(a). But surprisingly, they say 45(5)(a) applies only to individuals and HUF. Now, I do not know, why do you need to resolve difficulty only qua certain types of persons? Why don't you need to resolve difficulty qua all the taxpayers if that is your objective? Second thing, they say that 45(5)(a) will apply only to an area sharing agreement. Therefore, 45(5)(a) is not going to apply to the first type as also to the third type out of the three types of development agreement I made a reference to. Fair enough. Now, what are the changes? They say, if you're covered by 45(5)(a), then we will take tax from you, not in the year of transfer like 45(1), but we are going to take tax from you in the year in which completion certificate is received for the project which is developed on your land. Your land means the landowner's land. Landowner has to be owner of the land. Assessee who is entering into what they call it as a specified agreement has to be owner of land. Therefore, debate could arise as to if you are a lessee of a land, whether 45(5)(a) will apply to you or not. Right? Because 45(5)(a) uses the term owner. Now, in the year in which the project is completed, they say we are going to tax you on what? On the stamp duty value of the area coming to your share. So if you go to my example, they are saying under 45(5)(a), we are going to tax you on market value, which is going to be stamp duty value of the 60% flats which you have received. Compare and contrast this with what I explained. That what is consideration? The consideration in my case, in the example I said, was construction cost only of 60% of the flats. Now, mind you, if you go by Reckner rates, the construction cost in the city of Mumbai is about 4,000 to 5,000 rupees a square feet. Whereas if you pick up even an area like Borivali, etc., the stamp duty value of the flat is around 18 to 20,000 of rupees. Now, this large is the difference. The conceptual error, if I may say so, which the legislature has made is, legislature is presuming that I have transferred 100% of my land to you. What I have received from you is 60% of the flats. Whereas the other way of interpreting and executing the transaction could be that I have transferred only 40% of the development potential to you. In return, you have incurred construction cost of 60%. So this is the difference between 45(5)(a) and 45(1). At the threshold, I thought it fit to clear it. Questions will arise as to whether, number one, is the provision prospective or is it retrospective? Why am I raising this question? I'm raising this question because the legislature says we are introducing this provision to solve difficulty which the taxpayer is facing. And I know that Supreme Court has said that whenever a provision is introduced to resolve difficulty, the provision is retrospective. Now, if you say that the provision is, therefore, I'm coming to a question whether the provisions of 45(5)(a), which have been introduced on the statute, effective assessment year 18-19, are retrospective or are they prospective? As I mentioned, 45(5)(a) is a charging section. Therefore, according to me, in my personal view, it would be very difficult to contend that the provisions of 45(5)(a) are retrospective because a charge cannot be created retrospectively. That's number one. Number two, assuming I'm correct that the provisions are prospective, the next question arises, when you say prospective, are you saying that the provisions of 45(5)(a) will apply to agreements entered into on or after 1/4/17, which is after the section came into force? Or are you saying that no matter when the document is executed, if your year of transfer is assessment year 18-19 or thereafter, provisions of 45(5)(a) will? My personal take on that matter is that the provisions of 45(5)(a) will apply to all transfers which are happening in previous year relevant to assessment year 18-19 or thereafter. For the proposition that 45(5)(a) is prospective and not retrospective, we have decisions of Hyderabad bench of the tribunal as also the Pune bench of the tribunal. Right now, I've already explained you what is a development agreement. Supreme Court has, in the case of Fakirchand Gulati, in similar terms, explained what is a development agreement. Of course, the decision of the apex court was in the context of Consumer Protection Act, but there Supreme Court very, beautifully explains, and lucidly explains. It says that development agreement is the one where the landholder provides the land, which is what I told you. The builder puts up a bidding. Thereafter, landowner and builder share the constructed area. In our case, it was 60-40 in the example which I took. The builder delivers owner's share, which is my 60%, to the landowner and retains his 40% share. The landholder sells or transfers undivided share in the land corresponding to the builder's share of the building, because that 40% flats are his. So the corresponding 40% interest in the land also must go to the builder. So I'm going to convey that ultimately. The landholder will have no say or control in the construction or have any say as to whom and at what cost the builder's shares of apartments are to be dealt with or disposed of. Right? Therefore, development agreement is nothing but a business agreement. In the context of Chapter 20C, the Calcutta High Court in Madgul Udyog said that such agreements are in the nature of business arrangements and they are not agreement of sale. Now, we are basically dealing with capital gains. Therefore, I have to address a question that for capital gains to arise, first there has to be a capital asset. Second, there has to be a transfer. Third, there has to be consideration, right? Fourth, the cost should be capable of being ascertained, because if it's a no cost asset, then I'll say computation mechanism fails. But mind you, this argument applies only till the period prior to amendment of Section 55 by the Finance Act of 2023, effective assessment year 24-25. Now, in the case of Sushil Kumar Agarwal versus Meenakshi, Supreme Court was dealing with a development agreement in the context of specific relief act. And if you really want to understand what development agreement, etc., is, does it involve transfer or no, it is very necessary to study the decisions not under the Income Tax Act. More so, you must go to specific relief act and look at how courts are looking at development agreements with reference to specific relief. Now, Supreme Court says essential incident of ownership of land is a right to exploit development potential, to construct and to deal with the constructed area. In some situations, owner may part with such rights to a developer. This is, in essence, parting of some incidents of ownership in an immovable property. Very categorical statement that this is parting of some incidents of ownership. Therefore, some rights which I have are getting extinguished because of, by virtue of being transferred to a builder developer. Therefore, undoubtedly, to my mind, there is a capital asset and there is a capital gain, right? Does a development agreement constitute joint venture? Supreme Court in Fakir Chand Gulati says, don't go by the title of the document. Please don't go by the wordings of the document. If the document may call it joint venture, but look at what? Look at the intention of the parties, whether they intend exercising joint control over construction or development and are accountable to each other. Therefore, to decide whether a development agreement constitutes a joint venture or no, the test is whether the parties are exercising joint control over construction or development and they are accountable to each other or not for their acts with reference to that particular project. If yes, fine. If not, then you say it is not a joint venture. Okay. We mentioned that for capital gains to be computed, there has to be a capital asset, there has to be a transfer, there has to be consideration, and there has to be gain arising as a result of transfer. Now we'll identify and we'll get into each of the components of these. Now, before I proceed further, just a few basics. What does development potential comprise of? when I say that I'm entering into a development agreement with a builder developer, what am I transferring to him? We said we are transferring development potential. Now, what exactly is development potential? Where does it come from? When I own a plot of land over here of 10,000 square feet or 10,000 square meters, what are my rights on this plot of land? I would believe that my right is to construct up to the sky. If I am the owner of the land, I can construct as much as I please, but law imposes a limitation on me. It is the development control regulations of the area in which the land is situated. They say, no, nothing doing. You're going to construct with an FSI of 1. When we say FSI, it means floor space index. Therefore, on a plot of 10,000, we can construct 10,000. That is the development potential which is married to the plot of land. You cannot separate it. Then, with passage of time, in 1991, the law got amended. The development control regulations introduced a concept of TDR, which is transferable development rights. Now, if I am the owner of the plot with 10,000 square meters, as I said, plot FSI is 1 in suburbs in Mumbai. Therefore, I can construct 10,000 square meters. The regulations now provide that no, if you have a TDR, then instead of 10,000, you can construct 20,000. So if I have more TDR, can I construct 25,000? The answer is no. There is an upper cap. The upper cap is 1 FSI becomes 2 by virtue of loading of TDR. Therefore, if I am the landowner and I have a TDR certificate of 10,000 square meters, then on my plot of land, instead of 10,000 square meters, I can now construct a building of 20,000 square meters. But to increase the constructible area from 10,000 to 20,000, I need TDR, right? For which I will have to incur cost. Now, this right to construct extra 10,000 is what I call it as a right to load TDR. I'm going to refer to this as a right to load TDR. Please understand, this right is a creature of development control regulations. You could not have acquired this right by paying a monetary consideration. Therefore, up to assessment year 23-24, if I have transferred the right to load TDR for a consideration, then no capital gains would be chargeable. Why? Because the cost of this right is not ascertainable. Cost not being ascertainable, the computation mechanism fails, and therefore the charge fails is what we have studied. However, effective AY 24-25, there is an amendment in section 55. And now they say that wherever the cost of any right is not ascertainable, we will deem it to be nil. Therefore, this argument is not going to work any further post assessment year 24-25. For the past periods, yes. Do I have any authority to support this? Yes, you have Bombay High Court in Sambhajinagar Cooperative Society telling you that cost of this right is nil and therefore no capital gain will arise. And you have dozens of Bombay tribunal judgments on this point. Right. So this is about the right to load TDR. Now come 2012, the DC regulations again got amended. And today you have a concept of fungible FSI. Now, what is this fungible FSI? Because of fungible FSI, you can construct further 35% by paying premium now, not by buying TDR, but pay premium to the local authority. Therefore, 10,000 of my base FSI, 10,000 of a right to load TDR became 20,000, 35% of 20,000, which is another 7,000 I can construct if I am willing to pay premium to municipality, which is called as fungible FSI premium. and there are premium FSI rights. Now, all these are rights which are attached to land. These rights I can transfer, and these are the rights which I transfer under a development agreement. Now, let's understand, as we will go along, we will also need to conclude whether there is a transfer. If yes, when, because my charge happens under 45(1) in the year of transfer. Now, when I sign a development agreement with a builder developer, is the transfer complete? And can I say that the charge to pay capital gains has arisen under 45(1), or is something more required? Am I clear on what I'm trying to explain? What I'm trying to explain is, does execution of development agreement, paying stamp duty and registering that, mean that the transfer is complete and under 45(1) my liability to pay capital gains tax has arisen, or is something else also required? For that, we need to understand that merely by my signing development agreement, the builder developer can do nothing. He will also need a power of attorney from me. He need a power of attorney from me because a development agreement in general law is not a transfer. In general law, immovable property can be transferred only by a registered conveyance. Development agreement does not amount to a conveyance, and therefore the builder developer, when he goes to the local authority with the development agreement, they are not going to entertain him. They will entertain him only if he has a power of attorney from me to act on my behalf. So municipality is approving plans not qua the builder developer, but they are approving plans qua the builder developer as a constituted attorney of the landowner. Therefore, possible to argue, and courts have accepted that. When we come to those slides, we'll deal with it, that transfer happens in the year in which power of attorney is executed. Now, I may have given you a power of attorney also, but what happens if I don't allow you to enter my land? Then again, you can do nothing, right? The transfer does not happen. You cannot use the rights which have been entrusted upon you by virtue of development agreement and the power of attorney which has been executed. Therefore, handing over of possession could be the third criteria or third possible year of transfer. Somebody may say, you may have given me possession. You may have given me the power of attorney. You may have signed the development agreement. But what happens if municipality doesn't approve the plans? If municipality does not approve the plans on my plot of land for any reason whatsoever, then the rights which have been granted to the builder developer are rights merely on paper. He cannot commercially exploit those rights. Therefore, a line of thinking is that wait till such time as the plans are approved by the local authority. In an area sharing agreement, that is still more important, because unless the plans are approved, I will not know which 60% is mine. And only when I know which 60% is mine, can I ascertain the construction cost of that 60%, because the construction cost of that 60%, if it's a separate independent building on the plot of land, could be different from the construction cost of the other areas, right? So this could be another way. The third and the last option could be that the transfer will happen only when you give me the duly constructed area. Till such time as you don't give me the constructed area, no transfer happens. Therefore, these are the 5 possible options which could arise, right? So what I'm doing is I'm just clearing the concepts at the beginning so that when we come to the relevant bullet points, it'll be easier to catch up and go back and relate to them. Okay. Now, the first question, are development rights a capital asset? The answer will depend on, is your land a capital asset? If the land for which you're giving development rights is a capital asset, the logical corollary will be that the development rights are also capital asset. If your land was stock in trade, the land which you are holding is stock in trade, then naturally the development rights which you are giving are also a part of your business asset or a part of your trading asset. So the computation will need to happen under the head profits and gains of business. It's not going to happen under the head capital gains, and therefore that's not subject matter of my discussion today. The next question is, when I'm holding land as stock in trade, it could be something which I have acquired as stock in trade, or it could be something which I acquired as capital asset, but I converted into a stock in trade, right? For which there is a separate provision. Now we have interesting arguments by assessing officers. They say, sir, in the development agreement, you have not transferred land. Land आपका था, land आपके पास ही है. तो transfer क्या किया आपने? कुछ नहीं किया. Therefore, जो भी पैसा मिला आपको, whatever is the consideration, I'm going to tax it under the head income from other sources. You're not a businessman, therefore he doesn't touch business income head. He goes and taxes it under the head other sources. In that context, Mumbai Tribunal in several decisions, the lead order being in Bharat Raoji Bhai Patel, said that the gains on sale of development rights are capital in nature and come within the definition of capital asset and therefore are taxable as capital gains. Next comes the question that if I have sold TDR, will the gains arising on sale of TDR be capital asset and be capital gains, or will they be business income? Again, Mumbai Tribunal in Adivaccha's case said that since your land was capital asset, the TDR which you received from municipality is also a capital asset that's inextricably linked with the land which you gave up to the municipality, and therefore when you sell TDR, the gain, if any, will be charged to tax under the head capital gains. Now, what is TDR right? Earlier I explained the concept of right to load TDR. I said the plot FSI of mine, which is 1, becomes 2, provided I have TDR. So I must go to the market and buy TDR. If I'm buying TDR, there must be somebody who is selling TDR, right? Now, whoever is selling TDR, where did he get TDR from? How does TDR originate or generate? How does one generate TDR in the economy? There are lands which are reserved for specific purposes. Some lands are reserved for gardens, something is reserved for hospital, something is reserved for a school, etc. Now, it is the obligation of the government to acquire that land and use it for the purpose for which it is reserved. But government doesn't have that kind of resources. So government says that, look here, your land is reserved for a garden. So any which ways, we will not allow you to construct anything on this plot of land because the reservation is for a garden. Therefore, what? Therefore, you come and give your land free to the local authority. In return, the local authority, instead of giving you value of your land, will give you a certificate known as development right certificate, or what a common man understands it as a transferable development right. So if you had a plot of 20,000 meters, which you gave to municipality for a garden, the municipality will give you a certificate which will entitle you to construct 20,000 square meters. So on that certificate will be written that Mr. X, the owner of this certificate, is entitled to construct 20,000 square meters. That 20,000 square meters being the development potential of the plot of land which you have given free to the local authority. With that certificate, you will come to the market and you will sell me the certificate. That is how you will realize consideration for the land which you gave to municipality free. Now, please understand, here there are 2 steps involved. Step number 1 is you're handing over land to municipality and municipality giving you a TDR certificate. That is transaction number 1. The transaction number 2 is you're selling that TDR to me, which is a second independent transaction not connected with the first one. In the first, there is a transfer of land. The consideration is the value of the TDR which you received. In the second case, it is transfer of TDR, and the consideration is going to be the money which I am going to pay you for purchase of TDR from you. Am I clear on this? Now, in Adivaccha's case, the question arose before the tribunal as to whether the TDR is a capital asset or no, and the tribunal said, yes, it is a capital asset. Again, the question arises as to whether this TDR, the holding period will start when? Because I know that the computation and the rate of tax is different depending on the nature of asset, whether it is short-term capital asset or long-term capital asset. As I said, land in my, the TDR certificate which I received is a second capital asset, first capital asset being land. Therefore, qua this independent capital asset, which is TDR, how do I compute holding period? I may have purchased land 10 years back. I gave it to municipality in year 1, I call it, right? I mean, which is year 11, right? Municipality being municipality, it takes 1 year time to issue me a certificate. So in year 12, I received TDR certificate. But land I gave in year 11, right? 10 years I was holding land. 11th year, I go and give it to the municipality. Municipality takes the land, but to issue me certificate, bureaucracy in this country takes 1 year's time. And in year 12, I receive the certificate. Question arises that if in year 14, I sell this TDR, right? Is it short term or is it long? I will compute my holding period of 3 years from which point in time? Should I compute it from the point in time when I handed over my land to the municipality, or should I compute it from the point in time when I got a TDR certificate from the municipality? The correct proposition is, and which is supported by the decisions even in Adivaccha's case, is that you compute the holding period with reference to the date on which you handed over your land to local authority. On that date, the transfer of land happens, the consideration accrues to you, and the holding period of the new asset commences, right? Similar issue arose in the case of a landowner who entered into a development agreement to receive constructed flats, and out of the flats which he received, he sold 2 such flats. A question arose before the tribunal as to whether, for computing holding period of these flats, should the holding period commence from the date of transfer of development rights, or should the holding period commence from the date when I received the ready flats from the builder developer? And mind you, the answer could be different. The tribunal in Jayat Vikanand Rao's case says that qua the flats which you receive, the holding period commences from the date on which you transferred your development rights to the builder. So in the year in which you offered capital gains qua development rights will be the year from which your holding period of the flat commences, notwithstanding the fact that the flats in that year were not even in existence. They came into existence much later. Also, if for any reason, the holding period of the flats is short-term in nature, right? The tribunal says, and rightly so, that there can be 2 gains, one relating to land and another relating to the flat. The gains relating to land will be long-term, the gains relating to flats will be short-term. Okay, this right to load TDR FSI is also a capital asset for which I said there is no cost of acquisition, etc. But for the proposition that right to load TDR FSI is a capital asset, you have Mumbai Tribunal in Chetna Trivedi's case, right? And yeah, an interesting case arose before the Mumbai Tribunal in the case of Dattani development. They were builders. They purchased land. They were builders. They purchased land. They reflected that as stock in trade in their books of accounts. Then they sold that piece of land. When they sold that piece of land, the assessing officer found that the consideration is much lower than the stamp duty value. So he wanted to apply section 50C. The AO wanted to apply section 50C. In those days, 43CA was not on the statute. So I'm talking of a period pre-43CA. So he could have taxed it on stamp duty value only if he brought the subject matter under capital gains. The AO went ahead and applied 50C. The matter reached the tribunal. When the matter reached the tribunal said that here is a plot of land which is not capable of being developed. There are encroachments, etc. Therefore, what? Therefore, they say you could never have acquired this as stock in trade. Therefore, if I acquire a land with knowledge of encumbrances and I'm aware that the development on such plot of land is not feasible, tribunal says this is not stock in trade, this is. I may not personally concur with this view, because I can always deal in encumbered land as well. I mean, maybe the facts in that case were bad, but nothing stops me from dealing in encumbered properties as well, right? But this is it, so you need to be careful about this. Now, this period of holding qua TDR, I already mentioned Adi Bachcha's case. I also dealt with the holding period of flats which I received under a development agreement. I said, go back to the year of transfer of development rights and commence your holding period from there. For this proposition, you have Kolkata Tribunal in Vikas Bail's case, where Kolkata Tribunal follows the decision of AAR in Jasbir Singh Sarkaria's case, where Jasbir Singh Sarkaria's case, the AAR says that no, we are not concerned with the occupation certificate. We are concerned with the title of the flats. When did you acquire the right in the flat? You acquired the right in the flat in the year in which you transferred the development rights. So when you transferred development rights, you acquired right in the flat to be constructed. So that is the starting point, according to AAR in Jasbir Singh Sarkaria's case, which rationale is followed by Kolkata Tribunal in Vikas Bail's case, right? Now we come to whether there is a, so this was about capital asset. Now we come to transfer. Now, is there a transfer? If yes, under which clause are we talking? When I enter into a development agreement, is there a transfer? If yes, under which clause are we talking? Are we talking of sale? Undoubtedly. Is it an exchange? Is it an exchange? Maybe somebody can tell me, yes, you have exchanged development rights for flats. But if you go by definition of exchange in Transfer of Property Act, exchange presupposes existence of two things simultaneously when they are being exchanged. Here, the flats are not existing on the day when I enter into a development agreement. Therefore, difficult to say it's an exchange. Possibly, it is relinquishment of my rights or extinguishment of rights in the asset. I mean, right? The most commonly used clause, rightly or wrongly, is clause 5, which is transaction involving allowing of possession of any immovable property to be taken or retained in part performance of a contract of the nature referred to in 53A of Transfer of Property Act. Important expression being contract of the nature referred to in 53A of TOPA. We'll come to a Supreme Court decision which has been pronounced recently and which changes the understanding completely. So up till now, revenue was left, right, center invoking 247.5, saying that if you have handed over possession of the land to the builder developer, it is a transfer because of 247.5. We are going to see that, right? And other possible clause was 247.6. What is 247.6? Any transaction which has the effect of transferring or enabling the enjoyment of any immovable property. Bracketed portions is not relevant for me, therefore I did not read it. According to me, explanation 2 is also relevant, though revenue has so far not attempted. Explanation 2 says that the transfer includes and shall always be deemed to have included disposing or parting of an asset or any interest therein. Development rights is undoubtedly an interest in land. When I enter into a development agreement, I am parting with that interest of mine. So going by explanation 2, according to me, possibly there is a transfer. Of course, this definition of transfer does not apply to an asset held as stock in trade, because 247 very clearly says transfer in relation to a capital asset includes, and then 1, 2, 3, 4, 5, 6, right? Now, is this an exchange? You have Mumbai Tribunal in Bharat Raoji Bhai Patel telling you, yes, this is an exchange. But you have Hyderabad Tribunal, which I believe to be on a better footing, which says that no, for an exchange to happen, both the things must exist simultaneously. And since flat do not exist when the development rights are transferred, you cannot really call it an exchange. That's the ratio of. Coming to the year of transfer, I have already mentioned the 5 options which we had: the year of execution of DA, the year in which POA is executed, the year in which possession of land is handed over, plans approved, year in which 53A ingredients are satisfied, and last, the best one for the SSE, year in which I receive my constructed area. Now, for each proposition, I have in the presentation given you series of judgments. So if you want decisions for the proposition that transfer happens in the year of execution of JDA, you have all these decisions beginning from Chhatrabhu Dwarkadas Kapadia, Bombay High Court, lead judgment, to Andhra Pradesh High Court in Potla Nageshwar Rao, Karnataka High Court in DK Dayalu, and then followed by several tribunals. If you want to go by the year in which POA is executed, you have decisions of Chennai and Hyderabad benches of the tribunal. In Tamil Nadu, Brick Industries is Chennai bench of the tribunal, and you have Hyderabad bench in Nancy Divakar Hospital's case. If you want to go by year in which plans are approved, also you have several decisions. Maximum decisions you will get in the context of year in which possession is handed over. Now, here I have something to say. When do you regard that possession is handed over? There's a difference between a license and a possession, to which I'll come. But for the time being, just keep in mind that 247.5 is being applied by the revenue in the year in which physical handing over of the land happens from the landowner to the builder developer, which now Supreme Court has in Seshasai's case clarified that if you hand over physical occupation of the land for the purpose of constructing and in accordance with the terms of the development agreement, it is not possession, it is merely a license, and therefore 53A ingredients are not satisfied, says a 3-member decision of the Supreme Court, right? Now, we do have, now, clause 5 makes a reference to contract of the nature referred to in 53A. Now, what do you mean by contract of the nature referred to in 53A? Do you mean only possession being handed over, or possession being handed over is only one of the ingredients of the contract of the nature referred to in 53A. You have Supreme Court in Balbir Singh Maini's case, where Supreme Court tells you that this expression, contract of the nature referred to in 53A, would take you to 53A of the Transfer of Property Act. And once you go to 53A of the Transfer of Property Act, you find it is not one condition, but 6 conditions need to be satisfied. Only when all 6 of them are satisfied, can you really say that it is contract of the nature referred to in 53A of the Transfer of Property Act. Now, what were the facts before the Supreme Court? The facts before the Supreme Court were that the Supreme Court was dealing with an assessee who had executed an unregistered development agreement. Mind you, the agreement was unregistered. Then there is an amendment in 2001 by virtue of Registration and Other Related Laws Amendment Act of 2001, which amends 53A of the Transfer of Property Act and sections 17 and 49 of the Registration Act. By virtue of this law or these amendments, now you can get protection of 53A of TOPA only if your agreement is registered. So the argument before the Supreme Court of the revenue was that we don't have to get into each of the ingredients of 53A. What we have to look at is whether possession has been handed over or not. Supreme Court said nothing doing. When a reference is made in one law to the provisions of the other law, you have to go to the other law, check that all the ingredients of that particular provision are satisfied, and then if at all the conditions of 53A are cumulatively satisfied, only then can you say that the expression, I mean, your transaction comes within the expression used in 247(5). They said in the facts before of the case before us, agreement is not registered. Therefore, it is not a transaction of the nature referred to in 53A of the Transfer of Property Act, right? Now, so that's so far as 247(5) is concerned. I'll in a minute also come to 6 conditions which are there. Supreme Court in Balbir Singh Maini's case says that the coordinate bench in Shriman Suryavanshi versus Prahlad Suryavanshi has explained the conditions. So you have 6 conditions of 53A explained by Supreme Court in Suryavanshi's case, says go and look at those. If all of them are cumulatively satisfied, you say that the transaction is of the nature referred to in 53A of the Transfer of Property Act. One of the important conditions there is, please look at the 6th one, the transferee, which is the builder developer, must have performed or must be willing to perform his part of the contract. So if in the facts of your case, the builder has not performed or is not willing to perform, then you can say in this year, certainly the transfer has not taken place because one of the items of 53A of Transfer of Property Act is not satisfied. And this contention has been taken not in one, but at least in 15 or 20 cases, which are there on the slide before you. In fact, it's 2 slides, right? Now, lastly, you have interesting decision from the Calcutta and the Allahabad High Court telling you that the transfer will happen in the year in which you receive constructed area. So till such time as the construction is not complete and you have not received constructed area, there is no question of paying any capital gains tax. As you see, there is a controversy, and on each proposition you have several decisions. Legislature had this in mind while introducing 45(5)(a). But the remedy is worse than the disease. What they have now done is they are saying we are going to tax it in the year of completion certificate, but we are going to tax you on the stamp duty value of the flats which you are receiving, which is, according to me, much worse than paying tax possibly earlier. Okay. Now, in the case of Infinity, the Supreme Court, the Calcutta High Court said that when a landowner enters into an agreement to receive constructed area, you have to decide when the transfer is taking place by reading the document. But they say there will be very, very rare situation where the transfer will happen simultaneously with execution of agreement. They say that it will happen only when the landowner receives his share of constructed area, and till such time as constructed area is not received by him, you cannot say that the transfer of development rights has happened to the builder. I mean, from the landowner to the builder developer. They give an example of a mason. They say if you permit or give possession of your flat to a mason, do you say that you have handed over possession in part performance of the contract and therefore 53A will be attracted? They say builder developer is on an identical position. They even take the example or a hypothetical situation that having given possession of the land to the builder developer, possible that builder may not give you the flats. Possible that builder may not give back the possession of land also to you. But they say that is wrongful act on his part. Such an act on his part will not be protected by 53A of the Transfer of Property Act. Therefore, according to Kolkata High Court, they say that they hold that the transfer will happen in the year in which landowner receives the constructed area from the builder developer. Okay. Allahabad High Court asks itself a question. They say, how do you expect a person to pay capital gain tax if he has not received any amount? In the instant case, SSC has honestly disclosed capital gain for assessment year so and so when the flats were sold. Therefore, again, Allahabad High Court says that only when you receive consideration do capital gains arise. I would feel that this decision may require reconsideration in view of the express language in 45(1), unless one takes a view that no, gains do not accrue unless do not arise, because 45(1) uses the word not accrue but arise. Gains do not arise till such time as consideration is received by me, right? Okay. Now, so this was Allahabad High Court in Nachu. If I have to support these propositions, I would support them with section 37 of the Contract Act, which deals with reciprocal promises. What does Contract Act say on reciprocal promises? It says that if we enter into a contract where I promise you something for a consideration which is your promise, then I will be expected to fulfill my promise only if you fulfill your promise. So it cannot happen that I have transferred development rights, but you don't construct and you don't give me the constructed area. That's the principle of section 37 of the Contract Act. I think that if one develops, one will be on a much stronger footing to argue that the transfer will happen only in the year in which I receive constructed areas. To the similar effect, you have Mumbai Tribunal in Aarti Sanjay Kadam's case and Bangalore Tribunal in N.A. Harry's case. In both these cases, the tribunals are holding that capital gains will arise in the year in which constructed areas are received. So we've dealt with capital asset, we've dealt with transfer, year of transfer. Now we come to full value of consideration. Now what is full value of consideration? Full value of consideration, as I mentioned, is the construction cost of the flats which the builder is constructing for me. How do I ascertain this? How do I ascertain this? If at all parties have agreed in correspondence, etc., to some commercial rate, that will become the basis. If you take up a view, if you take up a position in the course of proceedings that this is not ascertainable, then today, after AY 1314, I will take you to 50D and I will tell you that 50D says that where consideration is not ascertainable, then consider fair market value of what you have transferred to be the full value of consideration. Supreme Court in George Henderson had explained that full value of consideration is the value of what you receive, not the value of what you give. However, 50D has been introduced to overcome that decision of the apex court. And now, if you take up a position that the construction cost of 60% of the flat which is coming to me is not ascertainable, I will tell you, what have you transferred? You have transferred 40% development potential. What is stamp duty value of fair market value of this 40% development potential? That will become full value of your consideration if you are considering taxation under 45(1). If you're considering taxation under 45(5)(a), then of course the answer is going to be the stamp duty value of the flats which you are receiving, but the tax will be in the year in which you have received the completion certificate. Now questions arise that can the assessing officer go to the books of a builder developer, pick up the cost from there and tell me this is the value of consideration which you have received? Am I clear on what I'm saying? Question is that for me, the consideration for transferring 40% of the development potential is 60% of the construction cost of 60%. Now, who's constructing? The builder is constructing. So the assessing officer goes to the books of accounts of the builder developer, looks at the cost and says 10 crores is the cost incurred on constructing the full building. Out of this, 60% has come to you. Therefore, 6 crores I am regarding as the full value of consideration for transfer of 40% development potential. Is this contention of the assessing officer correct, or can I challenge this finding? According to me, this is incorrect. And tribunal has accepted these to be incorrect in several cases. The tribunal says that the builder may have wrongly accounted certain expenditures. There could be certain amounts which are related to general administration, etc., which may be loaded to this particular project. Therefore, you cannot rely on the books of accounts of the builder developer and tax me basis. If at all, I mean, according to me, that would be a strong piece of evidence in the possession of the AO. What AO can do is AO can ask me, or AO can confront me with those details, and then he can tell me that you find fault in this. And you show cause why I should not regard 60% of this particular amount to be your full value of consideration. Then the onus will be on me to demonstrate that there are items which do not pertain to my 60%. I will be entitled to cross-examine the builder developer. Quite possible, I'm not saying that the builder would have done it, but there could be some bogus purchases in that. Does not mean that I am to be taxed for bogus purchases which the builder has recorded in his books, or builder may have loaded cost of some other project where he gets tax-free income into this project where the income is taxable. Does not mean that becomes my full value of consideration. Therefore, I would say that find out if I were to get the 60% constructed from an independent contractor like Larsen & Toubro, Godrej Properties, etc., how much would they charge me? That would be the full value of consideration as far as I'm concerned. But as I mentioned, post 50D, you already have an answer available in the statute itself, right? But otherwise, you have series of decisions of Bangalore Tribunal in Nagraj, Delhi Tribunal in Vasavi Chand's case, and Mumbai Tribunal in Jai Trikanand Rao's case, telling you that the cost of construction is to be regarded as your full value of consideration. Can the AO tell me that I am taking market value of the flats which you have received as full value of consideration? To my mind, no, unless your document is badly drafted. If the document drafted is such that you have transferred full development potential to the builder and in return you are receiving 60% of the flats, then the AO may be justified. But if you have carefully drafted the document to ensure that what you have transferred to the builder developer is only 40% development potential, retaining 60% for yourself, appointing him as your contractor for 60%, then according to me, he cannot regard the fair market value of the flats except when he invokes 45(5)(a). Fine. Now that's now does 50C apply to a development agreement? 50C, as we know, applies to transfer of a capital asset being land or building or questions have arisen as to whether development right is land or building or both. Certainly not building, certainly not both. Is it land? Is development right land? When 50C uses the expression land or building or both, do you say the expression used in 50C is wide enough to cover development rights and therefore 50C will apply when there is a transfer of development rights? Or do you say, no, 50C does not apply to such? Do I have authorities? Yes. Mumbai Tribunal in Chiranjeev Lal Khanna, Arlette Rodrigues, Myrtle D'Souza, and Arif Akhtar Hussain, 4 cases identified, has held that 50C applies to transfer of development rights. As against that, you have decisions of Mumbai Tribunal again in Shakti Insulated, Voltas Limited, Ronak Marble, and several other cases to hold that 50C does not apply to rights in land or building. Therefore, what do? I have 4 cases on one side, 3 cases on the other. Do I have any High Court decisions? And can I conclude? See, wherever transactions have happened, I have to litigate the matter. I have no choice but to argue my matter, right or wrong, whatever it is, leave it for the authorities to decide. But where I am on a drawing board stage, where I am on a planning stage, what action should I take? Do I conclude that 50C applies to transfer of development rights, or do I say that 50C does not apply? If you go to income tax law, there can be at least a dozen places where there is distinction between land and building and rights in land and building. Example, section 27. Example, section 35. Example, 194 LC. Example, chapter 20C. And there are several more. Therefore, income tax law is consciously making a distinction between rights in land and land. So wherever they want to cover rights in land, they have expressly covered. Therefore, here they have not covered. Therefore, my argument is it's not covered. But at the same time, let me inform you that Bombay High Court has admitted appeal of the assessee in Chiranjeev Lal Khanna's case. So that's an open issue. Rajasthan High Court, there is a decision against you. Then, till now, we were under an impression that no, Bombay High Court has not admitted appeals of departments somewhere, I mean, in Greenfield, etc. Therefore, we can safely conclude that the position is settled. But Bombay High Court in Cancast says very clearly that we have never decided on merits that 50C does not apply to transfer of rights in land. Therefore, they have admitted the question of law in Cancast. Also in Keki, Bomi Dadi said a reassessment notice was issued to the SSC on the ground that 50C value of the leasehold rights which you have transferred is greater than the consideration which you have charged. The SSC came up in a writ petition before the Bombay High Court saying, quash this. Bombay High Court says, why should we quash it? He says it is settled position that 50C does not apply to rights in land or building. Bombay High Court said, we have never said that. In the past, where we have not admitted appeal, we did not admit appeal of the revenue on technical ground, following Supreme Court decision in Satish Modi's case. Now, what had happened was that Bombay tribunal in Atul Puranik's case decided that 50C does not apply to transfer of leasehold rights. Against this decision of the Bombay Tribunal, Revenue rightly or wrongly chose not to file an appeal. Subsequently, Greenfield's case came up before the Bombay Tribunal. Bombay Tribunal followed its earlier order in Atul Puranik's case. And they said, following Atul Puranik, we are deciding this also in favor of the associate. Against Bombay Tribunal in Greenfield, Revenue came to the High Court. High Court says, what has the tribunal done? It has followed Atul Puranik. Have you challenged Atul Puranik? The Revenue said no. They said, then what is wrong with the order of the tribunal? Supreme Court in Satish Modi's case says that if Revenue does not prefer an appeal against a particular order of a judicial forum, say tribunal in this case, and in subsequent case, if tribunal follows an earlier order and decides, then in the second case also Revenue is precluded from challenging the second order. This is the proposition of Supreme Court in Satish Modi. So Bombay High Court said, when we did not admit appeal in Greenfield, we kept in mind Satish Modi. But what was wrong in what the tribunal has done? Tribunal has merely followed its earlier order. Against that order, you have not preferred an appeal. So here, how can you come in? Appeal. I mean, that's what the proposition was. So Keki Bomidali said, another red flag. You already have Rajasthan High Court in Ramji Lal Mina's case telling you 50C applies to transfer of rights in land or building. Interesting issue arose in the context of wealth tax on closely held companies before the Bombay High Court in Jain Siaki's case. Now, as you know, Finance Act of 1983, by virtue of Section 40, levied wealth tax on closely held companies. It was not a tax on all the assets of the company. It was a tax on certain assets of the company mentioned in Section 40 of the Finance Act of 1983. One of the items there was land other than agricultural land. One of the items of asset was land other than agricultural land. Here was a company based in MIDC Pune, which was lessee of the plot of land, lessor being MIDC. The company did not pay wealth tax on this asset. So, AO taxed it. When the matter came to the Bombay High Court, the question before the High Court was whether leasehold rights in land are covered by the expression land other than agricultural land. Exactly same language in 50C. Bombay High Court said, yes, when you use the word land, it also covers rights in land. Leasehold interest in land is also land. Does it mean that the issue is open and shut? According to me, still no. Why no? Because we are looking at the Bombay High Court in Jain Siaki in the context of Finance Act 1983, which did not make a distinction between land and rights in land. Whereas in income tax law, as I pointed out, there are about a dozen places where there is a distinction made by the legislature itself between land and rights in land, right? So so much so about this applicability of 50C. So if you're advising, please keep all these, red flags in your mind before you take a decision. Now, when I enter into a development agreement, apart from the area which I get or the revenue which I get, I also get rent-free accommodation at times. The officers try to tax the value of rent-free accommodation. And I'm not talking of monetary amount paid. I'm talking of house given to me. The developer gives me a house, says, here is a 2,000 square feet house. You go and stay in that house till such time as we construct the building on the land which you are giving us the development rights. During the period when I'm staying in that house, naturally it's according to the officer, a valuable item which I'm receiving. and they value that and they include it as full value of consideration. Madras High Court in P. Madhusudan has said, no, you cannot do that. The value of rent-free accommodation cannot be brought in, right? So much so about this. Now, what is cost of acquisition of development rights? I have how much time with me? How much time do I have? 10 minutes? Okay. Now, what is cost of acquisition of development rights? As I said, development rights are the most valuable rights in the land. After having entered into a development agreement, at some point in time, I'm going to convey the land, and at that stage, I'm not going to receive any consideration. Therefore, my entire cost of the land becomes the cost of acquisition of development rights. This is point number one. Point number two, what are the loading rights and the rights which arise to me because of the development control regulations up to AY 23-24, I can take up a position that these rights do not have any cost. These are items for which cost cannot be ascertained, and therefore the computation mechanism fails, and therefore the charge fails. I rely on Bombay High Court in Samrajinagar. But post 24-25, this argument is not likely to succeed. Also, for the past period, please bear in mind that if you have acquired land after 91, possible that some AO may tell you, when you paid the price for the land post 91, these regulations were already in force. Therefore, you have paid some consideration for these rights. For fungible FSI and premium FSI, this situation will arise post 2012. So you'll have to get into it. An interesting case arose before Mumbai Tribunal in Ishwar Lal Manmohan Das Kanakia's case. Now, what's our proposition? Our proposition is that if the ingredients of the computation mechanism are not ascertainable, the charge fails. Correct? That's the proposition. We've been saying, iska cost nahi malum, therefore ye capital gain chargeable nahi hoga. Now, when I go to 48, I get three items as deduction. Expenditure incurred in connection with transfer, I get cost of acquisition, and I get cost of improvement. My question is that forget expenditure incurred in connection with transfer. Of the other two, if one is known and one is not capable of being ascertained, does the entire charge fail? Or will you tell me these are two transfers? So when I give development potential of a plot of land to a builder developer, which comprises of the plot FSI of one and also the right to load TDR, the second component is one for which there is no cost. Will I say that allocate the entire consideration on some scientific basis between these two rights which you are transferring, and for the first transfer, pay capital gains tax. For the second transfer, you may contend that it's not chargeable. Or will you say that no, this is one transfer. Who are you to divide the transaction into two? The builder would never have taken one leg without the other. He came to me because this had a development potential of 20,000. Had I told him development potential is not 20,000, he would not touch my plot. Therefore, what? Therefore, cost of acquisition is known, but this right to load TDR being cost of improvement is not known. One of the factors not being known, the entire computation fails. This is the ratio of Mumbai Tribunal. I find merit in the contention in Ishwar Lal Manmohan Das Kanakia's case. Interesting decision. So I thought I'll point it out. Now on 45(5)(a), I have mentioned that it's prospective according to me. It will apply to transfers which are happening after 45(5)(a) came into force, irrespective of the date of the agreement. The section applies only to individual and HUF. The tax will be in the year in which the completion certificate of the project is received, the tax will be on the stamp duty value of the area which you are receiving from the builder developer. Of course, you have to enter into a specified agreement. The term specified agreement is defined in the section itself to mean a registered agreement. Therefore, if you are a case like Balbir Singh Maini dealing with an unregistered agreement, then 45(5)(a) cannot apply to you. If you want 45(5)(a) to apply, go and register the agreement. Conversely, if you don't want 45(5)(a) to apply, see to it that your agreement is not registered, is one way. Second, if you are an individual or an HUF, 45(5)(a) will apply. Other cases, it is not going to apply. You should be an owner, debatable as to whether a lessee of a plot of land can be regarded as an owner or not. The share which you receive, should be a share in the area in the project which is being developed on that very same plot of land. So you cannot say, I'm giving you development potential of Bandra plot, but receiving area in a Khar plot of mine. That's not what will 45(5)(a) envisages. 45(5)(a) envisages receiving share in area in that very same project. Now, 45(5)(a) postpones taxation. 45(5)(a) postpones taxation undoubtedly to a year in which OC is granted. Can I act smart and I say I'm receiving 95% of the consideration in money terms and only 5,000 square feet of area? So I'm receiving 50 crores in monetary terms and only 5,000 square feet in area. Wait for taxation till such time as I receive that 5,000 square feet, even qua this 50 crore monetary consideration which I have received. The section does not have any control or any restriction on that, but this will be subject to GAR provisions. I mean, if you have artificially created it, then the GAR provisions may trigger in and one may examine the applicability of GAR as far as this is concerned. Okay. Now, now 45(5)(a) postpones the year of taxation, but does not change the definition of transfer. Therefore, what? Therefore, transfer definition remaining the same, all the principles which are discussed for the year of transfer will still apply. However, 45(5)(a) being non-obstante 45(1) postpones the taxability to a subsequent year, just as you have your 45(2) or what you have, where you convert your capital asset into stock in trade. They say we will take taxes in the year in which stock in trade is sold or otherwise transferred. Right? So why is this relevant? This is relevant in the context of claiming deductions under 54, 54F and 54EC. Okay, fine. This is as far as 45(5)(a) is concerned. I think will 45(5)(a) apply to revenue sharing agreements? Answer is obviously no. Now, please bear in mind that wherever 45(5)(a) applies, you are required to deduct tax under 194 IC on the monetary consideration which you are paying, and the rate is 10%. Issue arises, what did I say? 45(5)(a) will apply only to individual HUF. So supposing I am a company which is a landlord and you are a builder developer, and our understanding is that you will give me 25% of the constructed area plus 40 crore of rupees. So the question is, on the 40 crore which you are supposed to give me, are you required to deduct tax under 194 IC at the rate of 10%? Or are you correct in taking a position that 45(5)(a) applies only to individual HUF? Here is a landlord who is not an individual or HUF, therefore 194 IC will not apply. Now, what's the correct position? Let's look at this as the last issue. Yeah. Look at 194 IC. It says, notwithstanding anything in 194 I, any person responsible for paying to any resident, you are a builder developer, you are person responsible for paying to me, a resident company, any sum by way of consideration, the consideration, I mean 40 crore of rupees in my example, not being consideration in kind under the agreement referred to in 45(5)(a). Mind you, 194 IC is talking of agreement referred to in 45(5)(a), not a person referred to in 45(5)(a). And when you go to the definition of agreement referred to in 45(5)(a), you will go to the explanation and look at the definition of specified agreement. It says means a registered agreement in which a person owning land or building, not an individual, a person owning land or building or both agrees to allow another person. Is this or is this not an agreement referred to in 45(5)(a)? The answer is yes. The fact that I am not an individual, but I am a company does not absolve you from an obligation to deduct tax under 194 IC. Certainly a very highly debatable area. I would take up a view that to err on the safe side, even if I'm wrong, I would advise the client to deduct tax at source, right? And I would feel that in law also I'm entitled or I'm liable to deduct tax at source. I think I have crossed or reached my 5 or 10 minutes, which they granted me. If there are any questions and time permits, I'm willing to take. Otherwise, thank you very much for a patient hearing.
So, well, sir, it was wonderful, informative, and very knowledgeable session, I can say. And I'm sure all the participants will agree with me that you have explained in very detailed manner with proper case laws, relevant case laws, so that members can understand in a better way. So definitely on behalf of WRC, I would like to present our heartfelt thanks to you for your sparing your valuable time and for your knowledge sharing. Thank you so much, sir. So we are starting our next session, another exciting session. For that, okay. Sorry, we have received one question. If one question, we can take it. If okay. So, sir, question is a partnership firm is landlord of a land and building with tenants and the property is booked as stock in trade under current asset in the books of accounts at rupees 1 crore. So during 2016, partnership firm has acquired all the tenancy rights at a cost of rupees 2 crores. And now it is sole owner of the land and building. The firm has incurred certain other expenses, approx 2 crore on the said land and building, which is added to the stock in trade under current assets in the books of accounts. Now, the firm is entering into a joint venture with a developer and getting some amount immediately, rupees 2.5 crore and some duly constructed area later. So the firm intends to sell the area after receipt of OC of the redevelopment building. So the cost is like original cost is 1 CR, acquisition of tenancy is 2 CR, and further expenses is 2 CR. The total cost is 5 CR. So their query is like how the firm will be taxed for rupees 2.5 crore received upon signing of the development agreement. First question. There are 4 questions in that. So
At
should
the
I?
outset, this is a question on stock in trade. This is nothing to do with capital gains.
Correct.
I mean, the querist has very clearly said this land is stock in trade.
Stock it.
So therefore, I mean, the taxation has nothing to do with what I have discussed today. What I have discussed today is capital gains. This is a question on business income. Nevertheless, in the context of business income, entering into a development agreement does not constitute a transfer. Entering into a development agreement does not constitute a transfer. Transfer of a stock in trade happens only when conveyance is executed. However, you have one Bombay High Court, I think Suwari Investments or something, which is on facts. They held that where entire consideration was received and assessee had done his part of the obligation, he is liable to tax, notwithstanding the fact that conveyance has not been executed. Right? Now, in your case, you have received a part of the consideration. The rest of the consideration is yet to receive. Depending on the terms of the contract, it should be possible for you to argue that the transfer has not taken place. The transfer will happen at a later date when I receive constructed area. It is at that point in time that lock, stock, and barrel development rights will stand transfer. However, the obligation of the developer under 194 IC may arise. Thank you.
Really, thank you. Thank you so much, sir. Yeah, so we are concluding our first session of today's year. Thank you once again. So now I would like to call upon our second speaker, Vipin Batavia ji. I request to Regional Council Member Hridesh Pankhania, please escort to the speaker to the dais. So without taking much time, I directly will request to my council colleague Hridesh, please introduce our today's speaker.
Good evening, everyone. I think it's my pleasure to introduce CA Vipin Batavia, sir. Our topic for this session is Charitable Trust Amendments and Compliance Form 10B and Law. I think having someone who himself is proactive in charitable activities and running his own trust too, let me welcome CA Vipin Batavia, who's practicing independently since in the name of Vipin Batavia and Company and his ex-partner in firm, Ms. Parekh Joshi Kothare. And he's practicing in this field since 35 plus years, mainly in the formation and taxation of charitable trust, NGOs, clubs, and association. A president of Chamber of Tax Consultants in the year 2003 and 4, a chairman of various committees, and was a chairman of Journal Committee of CTC for 3 years, which publishes the Income Tax Review, a renowned professional magazine. Was actively involved in the various committees of BCS and WRC as well. He has his expertise pertaining to charitable trust institution, including Charity Commissioner, Income Tax, FCRA, and the CSR matters. Co-author of a book on charitable trust under printing published by the Chamber of Tax Consultants, delivered lectures at various professional bodies, trade associations. He is represented before Standing Committee for the changes in DTC draft on charitable trust. He runs his own trust and he was a national secretary of All India organization called the Dharam Bharti Mission. Let's welcome him with a huge round of applause. CA Vipin Batavia. I'm sure this session is going to be amazing. May I now request our immediate past chairman, CA Murtaza Kachwala sir, and CA Shweta Jain, the immediate past secretary, to please welcome sir with a memento. Thank you, sir. I'll request Vipin sir to kindly take charge of the session. I'll just.
नीचे वाला ही है ना? हाँ, इसका पेज 7 देखो। 7 क्लिक करो। नहीं, इसके बाद वाला भेजा। आपको ये चाहिए पेन ड्राइव? इसके बाद भेजे हैं तो करेक्ट है। धवल इसमें चेंजेस किया ये पहले का है। Line number 7. दो आपको एक मिनट इसमें देखो वायरस था डबल पहन रहे हो करेक्ट बिल्कुल बिल्कुल अभी आइए Thank you, dear. Good evening, friends. I think it's 6:45. Already there is shortage of time. So I have less than 15 minutes out of the allotted time. Dear Mr. Murtuja, immediate past chairman, Mr. Rudresh, WRC council member, and fellow brothers and sisters. It gives me immense pleasure to talk to you and share my views on my favorable topic, that is charitable trust. Earlier I have seen people were not that much interested, or that it was not considered that hot topic. But thanks to our finance minister, in last 4 to 5 years, then many CBDT circulars, new audit reports, Supreme Court judgments. Even recently also, in another case of Baba, that is also again confirming the earlier judgments. So this topic as such is complicated. But now with these amendments, it's become more complex and complicated. And the most important part of it, we all are taken granted. And there are provisions for cancellation of registration, which the powers they have given to CIT and PCITs. So, looking at those additions to the cancellation provisions, I think it is really very important, particularly on we chartered accountants who are representing, who are auditing. And anything goes wrong, then it will be a question of cancellation of charitable trust and vis-a-vis to applicability of 115 TD provisions. I think you must be aware, because that provision is not latest one. So today I have decided, because I have 1.5 hours, which I asked with the management at least minimum 2 hours to 2.5 hours to explain in more detail and all that. But I think they have also got some constraints because if 2 speakers fitting to 3 hours, so 1.5 hours is justified. I will try to cover what the best, it means the important amendments. And one more thing, I am going to explain the law as on today. Because there are confusions, there are problems, there are still no clarification in certain points, which time will tell. I am not going to explain or cover in this topic anywhere any judgment. Because purely what is the law as on date? Because that understanding of the law will make you better person to perform rightly on your charitable trust clients or advise them in the right manner. Because audit report is also calling you to certify true and correct. Earlier it was true and fair only. Now there are 2 parts if you see audit reports. True and correct, annexures, and true and fair. So that is more problematic. Anyway, now coming to the topic proper, I have decided I will go for topic wise, not chronological, the amendments or circulars or that. And time permits, to whatever extent we can discuss, we'll see to it. Now, corpus donations. Because there are at least 4 topics which are hot topic as on today. That is corpus donations. Then there are inter-charity donations. Then there is a definition has been defined what is a specified income and specified violations vis-a-vis to cancellation of registration. So these 4 topics we'll cover in detail. So the corpus donation in Finance Act 21, it has decided, I think it is amended, because after listening Mr. Punjabi, every argument, every discussion was based on some judgment. And I think he has referred more than 100 case laws. So corpus donation are allowed as deduction subject to condition that such contributions are invested or deposited in 11.5 mode. Earlier, there was no such condition. Corporate donation you have received, it's a capital receipt, and 11.1D exemption was allowed, and we were claiming. Not only that, spending out of corpus was also allowed as a application of income. Moreover, in Bombay High Court, GK Charities case, even if given the if it is invested in immovable property, then depreciation was also to be allowed. So to curb these type of loopholes or judgments, they have changed the whole concept of corpus donations. Now, corpus donation, if you have received during the year, you will get deduction under 11.1D only if you have invested in 11.5 mode. Now here, bank balance deposit into bank account is also considered 11.5 mode. As long as it is lying in the bank account, it is in the 11.5 mode. But there is one more condition has been added and maintained specifically for such purpose. And there is no time limit how long you have to maintain. Because in the speech, finance minister, even in their memorandum for amending the law, they have said they want that the total corpus of the fund, even Under Secretary came from Delhi, which there was a meeting with them. He said, we want that corpus should be invested and intact. They're fine. It's an ideal situation. But there are circumstances. There are certain needs or certain projects. You need to spend that. And that spending is allowed. In Maharashtra Public Trust Act, even ROC also, Section 8 companies also. Even your trust deed may, it should be permitted by trust deed also. So spending is now that again, you can spend, but if you want 11(1)(d) exemption of corpus donation received during the year, then you have to invest it. There is no any time prescribed when it is to be invested. There is no time limit prescribed how long you have to maintain it. But maintain is specifically for such corpus, so it is lifetime maintenance. You have to continuously maintain that. Only income of that corpus should be utilized for the objects of the trust. Then explanation 4 to 11(1)(a) was added. That is from assessment year 22-23, where it says application or spending from corpus shall not be treated as application of income in that year. In the year in which you receive the corpus donation, and if you spend for the objects of the trust, it will not be allowed as application of income in that year. We'll see how it is to be allowed. And the same provision they have brought in for loans and advances. If you have make some utilization of fund out of the borrowed fund, then that will also not to be treated as application of income. So it is clear. Okay, you have whether, here one more thing. If you have received corporate donation, you have not invested in 11(5) modes, so you will not get 11(1)(d). And you have applied for the objects of the trust during the year, then you will not get application as well. So this amendment is very unfair, because during the year you are not getting any deduction. So that will constitute as a income. And 224(2)(a) very clearly says any contribution including corpus donation except section 12(1) says still there is no corresponding amendment that will come to know later. So here, if applied during the year out of the corpus, the application will not be allowed. Now, it will be allowed the year in which you deposit back into 11(5) mode. For example, you have received 10 lakhs of donation during the year. You have applied for objects of the trust, so you will not get even 11(1)(d). Even application also you will not get. But in the next year, suppose out of that, one more condition is there, it should be out of the income of that year, not again out of the corpus. So it is to be invested to the extent whatever you have surplus fund into 11(5) modes, then that amount to that extent will be allowed as application of income in that year. And the same thing is with the loans and borrowed funds. There it is only repayment of borrowed fund will be allowed as an application of income in the year in which you repay to whatever extent you repay. Further in 2023, they have added some more conditions for claiming application in that year in which you are going to get it. That it should not be corpus donations or out to or other trust. You have received, that will not be counted. Even TDS provision is applicable to that extent, it will not be allowed. Cash payments 48(3)(3)(a). No. And there is one more provision which will come later, that is actual payment basis. Because now, after the assessment year 22-23, the application of income is allowed only on payment basis. So that only on payment basis you will get deduction. Then directly or indirectly benefited to the persons covered under 13(3). So in general parlance, we know, since we are studying as a CA student, interested persons. Now 13(3) have mentioned those interested persons. I think you all must be aware of that. Only one point is troubling in that, means authors, trustees, their relatives, the concern in which they are partners or though they are directors, those all covered. And any person who has donated in the lifetime of the trust in aggregate of more than 50,000 rupees. And in maintenance of books of account, you have to keep that record. In ITR 7 also, you have to fill Those who are covered under 13.3 list you have to attach. You tell me, how can you maintain that if you have a trust which is more than 40 years old, 30 years old, 50 years old? It's not practical. We have asked time and again for many years, please delete this requirement. At least you increase the limit. So 10 lakhs or 50 lakhs, 25 lakhs, whatever. So 50,000, they have 71 or 73, this was added. Still the same is going on. But we professionals, we have to follow the law. We have to comply with the provisions, and department has to administer those laws. So whatever amendments are there, let us not cry on that. Accept it. Yes, this is the law. And I tell you, I'm looking majority of the persons who are seniors. I tell you, and this is my experience as well, we have seen many such amendments in past. At the time when this goes, it is settled down. And we are capable of doing that. Our education, our experience, our knowledge, they should not underestimate us. But troubles are there. It is everywhere. One more thing, which I wanted to cover in the beginning. There are so many amendments, so many circulars, judgments, notifications have come in short period. That is in just 3 years. So that is what it is really become very complicated. If it is over a period of time, then we absorbed one, we absorbed then again, we absorbed then other one, and we are there. But it has come within the short period of mainly in 3 years. So that is why it is really, and the impact is very bad. Now again in 2023, they have put a restriction, means time limit. That is redepositing of those corpus donations which you have applied and you could not get the application of income, limited to 5 years. Same way, repayment of loans is also limited to 5 years. So the year in which you apply that money, from that year, 5 years. See, there are certain projects which has got long gestation period. There are certain projects wherein they have to use corpus donations only. So they will suffer. And mainly loans and borrowings. The longer the period is better for the trust. Your EMI less, your interest is also there, and you get more time to repay. But they have restricted to 5 years, as if now it is applicable. One more amendment has been brought in 2023 budget, because I am covering all 21, 22, 23 on corpus donations. So that matter of corpus donation gets clear. Any amount which has been you have received and utilized before 31/3/21 will not be considered for redepositing and claiming again the application of income. It's fair enough. Once you have already claimed it, you should not be allowed again on that issue. Now, there is one technical flaw not amending 12.1. Section 12.1 says, as for any voluntary contribution not being towards to corporate donation shall be deemed to be the income derived from the property held by the trust. So correspondingly, they have not amended Section 12.1. So as of now, either you have option, you can claim 11.1D, as well as you can claim 12.1. If you have not invested and utilized, you can claim 12.1. It is there on the statute. So there is a flaw that remained to be amended, I think. And it is one more place. It proves that all the amendments has brought hastily, just to bring amendment, they brought it. But my suggestion in this regard is, please do not plan or depend on 12.1. Because the main provision 11, it says you will not get 11.1D. And I am certain that in the next budget or maybe in between, they will correct it. And when they will correct it, it will be retrospective. So if you have planned any income or affairs of the trust, then you may have to face the problem. So not to rely, we can argue. It's a matter of argument. You can in the court, if you have to face that, then you say you are allowed. Well, that is different. But please, this is my advice, personal, that not to plan on this base. Shall we take questions on that topic together or all together? Because my thing is this, if I want to clear those complicated topics. So any question on corpus donations, we can take it right now. Because then I will not get the time, you see. Fine. No problem. I have no issue. I can answer just now, cover it because we are on corpus donation. I think you must have understood. One more advice, practical. If that trust going to invest that money, then only you accept corpus donations. And if you are going to spend that money or going to apply that money during the year, then accept normal general donation. So it will solve all these complications. Yes. What's the question? No, then there is only this fund of building fund, which becomes, there are judgments, which says it is to be treated as a capital receipt. Because there is a direction, it is for the building fund. Now, building fund, you have not invested. You have option for 11.2. You can accumulate that money. But if you consider it as a corpus donation, then you have to put it in the fixed deposits or 11.5 mode or bank balance also. But in bank balance, you have to maintain specifically for that purpose. Somebody has suggested open a separate bank account so that it is maintained for that. I think that's a very, very safest mode. But even in your bank, also in your balance sheet, if you show separately, that we are doing in our office also, that we show that bank balance pertaining to the corporate donations is the other receipts. So we have reflected, but you have to maintain that. But it is very difficult because anytime if bank balance goes down below the corporate donation, then you are in trouble. So immediately you can deposit in fixed deposits before that situation arises. Now, inter-charity donations. Current year. This balance, it won't be affected. This provision of not allowing the corporate donation is received during the current year.
So I can use my opening balances.
Yes. You can. ITR 7, you have to reflect. There is a chart where opening balance, utilized during the year, balance. There is no, even you can donate. Corpus donation or accumulated fund. It is if you have received corpus donation during the year, where you are going to claim 11.1D, your opening balance, you have already claimed in past 11.1D. So here, that is not gone. Now here, if you want to claim that, now provision says you have to invest in 11.5 mode. Immovable property is also 11.5 mode. But mind it, movable assets are not covered. So be careful not to go for movable assets. If you see 11.5 list, movable assets are not covered. That also we have represented many times, but koi sunwai nahi. Please. There is no any time limit prescribed. Now balance sheet you will draw on 31st. There will be separate assessment. There will be separate processing, CPC as well. So that money is lying in your bank balance. So bank balance deposit in bank account is also covered under 11.5 that I have already said. Only thing you have to reflect in the balance sheet separately. You say why media? I have suggested and people are following that. And actually there is no problem. We have to see how the things come. But absolutely right. Not only 31st. Even in the last week or 15 days before you have 15 days, okay, you can put into fixed deposit. But bank balance is also 11.5. So you can claim 11.1D. Yes, it is charitable and religious. Everywhere the act says religious and charitable purpose. The corpus is corpus. Your purpose is religious, means that your activities are religious. Now even there is amendment in cancellation in other ways. You have to spend your money only on the objects which is mentioned in your trust deed. If it is not covered in your trust deed, if you have spent, then there is a violation. Now, inter-charity donation, that is another hot topic has come up. I have given, still, the inter-charity donation is required to be given on the similar objects of the trust. Means the donor and the donee should have similar objects. Inter-charity donation, other than towards corpus, is treated at par with direct application. These are all background. Means earlier, if you are if you donate to another trust, that is registered trust, not unregistered trust, then it is at par with the application, you get 100% application of income. Then not treated as an application of income. That is, in 2017, it was amendment that if a trust out of the income donates as a corpus donation to another trust, then that will not be treated as application of income. Because there was double deduction, the donor trust was claiming as application of income, and the recipient trust, donee trust, was claiming 11.1D. So that loophole was plugged in 17. Then funds accumulated under section 11.2, that is accumulation for 5 years for a specific purpose, filing of form number 10. So that there also you cannot donate to another trust that fund, that is to be actually spent for the purpose for which it is accumulated. Inter-charity donation to a non-12AA or non-FCRA organization is generally not permissible, but has not been held as illegal activities or a reason for cancellation. It's not illegal. But in Income Tax Act, it is not allowed. A charitable organization can be considered as a charitable in nature, even if the entire donation is mobilized or is given to another inter-charity donation. 100% income is donated to another trust. Is also allowed as application. These are our earlier provisions. Because earlier assessments, earlier matters is still going on. That will continue for another 4 years. Then the funds given to inter-charity donation shall be treated as application of income, even if it might not have been applied by the donee trust. If donee trust has received that donation, but they have not spent, in that case also, it is allowed as a deduction to the donor. Now, yeah, again, the old slides have been attached. Wait, all right. Finance Acts 23 in clause 3, not to worry. Explanation 4 to 11(1)(a) is added. Explanation 4 is with effect from 1/4/24, means assessment year 24/25, means current financial year 23/24. Explanation 3 says any amount credited or paid other than the amount referred to in explanation 2. Explanation 2 is for that corpus donation not allowed as a application if you have applied. To any registered or trust or institution, as the case may be. Institution, I am referring that all 1023C 4, 5, 6, 6A together, as the case may be, shall be treated as application for a charitable or religious purpose only to the extent of 85% of the amount, mind it, credited or paid. I repeat, 85% of amount credited or paid. The explanation doesn't use the word donation. Explanation says credited or paid. So this has created many problems. Problems in the sense, suppose if you want to help a patient and you want to donate to Bombay Hospital, or you want to donate directly to Hinduja Hospital. So those are just Lok or Nanavati. They are all charitable trusts. If you paid them for a treatment of Mr. X, earlier it was allowed. But now it has become problematic because you have paid to the trust. For what purpose? That is to be seen. Now, if you want to pay school fees for a student, we prefer as a trust or as a trustee or as a prudent person. We don't know if it goes to his personal account, whether he is going to utilize for the purpose of education or medical treatment or not. So we prefer that we donate to the school directly or college directly, so that we are satisfied that yes, it is for their education or medical purpose. But here also the same problem arises because it is paid. So this situation, we have to take care how to solve it. The only solution seems to be you pay him directly and ask him to pay the hospital and give you the receipt. All those extra care is to be taken. That is for your satisfaction. Even if you pay to the patient, income tax will allow. There is no problem in income tax. But as a board of trustees, if you are paying to someone, you have to see that it is used the purpose for which it is paid. So this problem has arisen. Now, the second problem arises with this provision is, what about then 15%? You have donated 100 rupees, 85 will be allowed as application of income. Very simple provision, no problem. You have used the word paid and credited or paid, has created another unintended problem. And here also bigger problem. Because that 15%, whether it will be allowed to you as accumulation under 11(1)(a), explanation 2 clause 1, that is 9A form, or 11(2), or if it is below taxable, then what will be the situation? So I have prepared this one chart to explain the position. This is my opinion, my personal. There are different views. Other speakers, other authors have got different views. These views of calculating this working is on the basis of money available for accumulation. Because section everywhere says it is to be accumulated or set apart. Set apart means to keeping separately. Accumulation means you have money which you are accumulating for a purpose. So if you have no money, so how can you accumulate? On the basis of this principle, these workings are given. Now, first example is suppose you have 1 crore rupees income. Old provision says if you have donated to another trust 50 lakhs, you have spent amount 50 lakhs, 1 crore, all deduction you will get nil, no problem. Or total 1 crore you donate to another trust, that is the second point. Earlier provision, it was fully allowed. Now go to second example, 1 crore donation. You have donated 100% to one trust. So 85% means 85 lakhs you will be allowed. Your income becomes 15 lakhs. Now whether the 11(1)(a) 15%, that is without any condition, automatic accumulation, whether will it be allowed or not. And according to me, because you earn 1 lakh rupees, you have already spent whole 1 crore rupees. You have no money to accumulate. So these 15 will not be allowed as a accumulation. Even certain authors have also opined this. Now, second situation, 1 crore, 50 lakh you have donated, 50 lakhs you have spent. Total application 85% plus 50, that is 92.5 lakhs. Here 7.5 lakhs. Because you have donated 50 lakhs, that is 50%, that is 7.5 lakhs. Now in third situation, 1 crore income, 50 lakhs you have donated, 25 lakhs you have spent. So total application is 67.5 lakhs. And you have 25 lakhs in your hand. So you can get 15% accumulation without any conditions, without any form or that. You will get 15 lakhs as a accumulation, and you have 17.5 lakhs left with you further, that you can accumulate 9A or 10. So here income becomes nil. Now the one more example, you have 1 crore, 50 lakhs you have donated to another trust, 25 lakhs you have spent, 67.5 is application, 15 lakhs you will get accumulation. You have accumulated 16 lakhs instead of 17.5 of example number 4. So there your income remains 1.5 lakhs. In generally, to previous year and even in this year, that minimum 2.5 lakh is a basic limit. But the problem is created by defining the specified income. So point number 1 or point number A of explanation added, we'll see in the next slide, is creating this problem. And in this problem, there are two views, whether it will be allowed or not, whether you have to pay tax on 1.5 lakhs, 15 lakhs and 7.5 lakhs. I say yes, it is taxable income, but in 1.5, whether it is applicable or not, it's still not clear. Even these, whether accumulation of 15% will be allowed or not is also not clear, because I went on the basis of availability of fund. And that is a practical solution. We found that unless you have money, you cannot accumulate. Now coming to that below taxable income, we try to file a return. Okay, what income tax utilities are calculating. But still form number 7 utilities are not available. It has not come on the portal. So we could not even check with that with the income tax department, what is their view in ITR 7. So that time will tell us when we file a return with a nominal income 10,000, 25,000 surplus, and then we'll come to know whether it is calculating 30% on the basis of specified income or not. So till then, it is not clear. So I have put the notes whether the balance income falls under specified income. If it falls under specified income, there is one author, Mr. Manoj Fogla. I think so many people must be reading his book. He says it is liable for 30% tax. Then second, if yes, then the tax rate will be 30% or normal rate. That is not clear. There are 1/4 authors and the speaker says 30% will apply. According to me, it should be normal rate should be applicable. Because let us see the definition of specified income. New section 115 BBI. Whenever they don't get space or place anywhere, they go to 115 section. So everybody should read 115 section at least once to remind them what are the things are covered. So they have included 115 BBI and they have defined specified income of certain institutions. It is applicable from AY 23-24 from current year, previous year. So while filing the return, we have to see where the total income of any trust or institution includes any income by way of any specified income, not standing anything contained in other provisions of the Act. It's 11(1)(a) also, it speaks like that. The income tax payable shall be aggregate of the amount of income tax calculated at the rate 30% on aggregate of such specified income. Means there may be 2-3 specified income. That is possible. The balance other income other than specified income will be taxed at normal provisions. So this is here it says even means total here it is not talking about that minimum liable to be exempted. Here it talks about when suppose your computation comes 10 lakhs income, specified income is 3 lakhs. So on 3 lakhs you pay 30% and on 7 lakh normal provisions will apply. Whether accumulation, whether normal rate, whether whatever normal other provisions will apply. Means it will not be double taxed. Fair enough. No deduction in respect of any expenditure or allowance or set off or any loss shall be allowed to be to the SSC under any provision of the Act in computing specified income. In fact, deficit and losses are no more allowed. In the case of trust, it is not applicable. But during the year, if it is there, carried forward is not allowed. But during the year, if it is there, so this provision says that it will also not be allowed. You have to straight pay 30% on that. Now, what is specified income? They have defined. They have added explanation. That explanation A says income calculated or set apart in excess of 15% of the income where such accumulation is not allowed under any specific provisions of the Act. So this number 1A explanation is creating this problem. Whether in excess of 15% of income will be considered as a specified income. Even 1.5 lakhs, as per this definition, they say it is specified income. So time being, I suggest everyone, you accumulate 9A spending next year or 10 for spending 5 years and make your income 0 and file the returns presently. We'll have to see what clarification CBDT is giving. We have to see if there is no clarification, if there is amendment in the next budget or any case laws or judgments, and that takes time. It's a good thing that nowadays, if you file any IT appeal, you get a hearing in 1 month. And decisions are coming fast. Apart from that, this part A of explanation, what is the specified income, has created all these problems. For that, that chart is prepared and there are different views on this matter. It is advisable because I'll give my practical advices also how to come out of it. So presently, you accumulate that income and make your income zero. So that this all problems of definition of part one of first one of the specified income will not come to play. Then violation of accumulation with reference to 9A and 10. If you have accumulated and you have not followed those conditions of I'm talking in the form is very easy to understand. Means 9A is for 11(1)(a). That is option is given to the SSC either to spend in the next year or the year in which that income is received. And form 10 is for 11(2), that is accumulation for a specific purpose for 5 years. And you have to invest that 11(5) and you have to spend only for the specific purpose. If you default any of these conditions, then it will fall into specified income and straight 30% of tax. Then investment of funds in impermissible modes. Any payment you have invested which is not permitted in 11(5), that will also attracted as 30% specified income. But there is amendment in 2023 which says only that part of investment which is not in the permissible mode will be liable to be taxed. You will not lose. Earlier the provision was that you will lose the whole exemption. Gross income was taxed. And we have seen orders. Gross income is taxed. Some allowed establishment expenses. Some might be allowed expenses as well as amount spent on object of the trust also. And net amount they have taxed. So to bring all those things at par, there are certain further amendments to 2023 bill that we will see later. And income applied outside India not permitted, DR we are covering. Benefit to interested person directly or indirectly under section 12(2). So 12(2) says if there is a indirect benefit to the specified persons, including the donor of 50,000, relatives, even settlers, founder members may not be there, but their relatives will be covered. Mind it. The generation will be there. So it's very difficult. That is why charitable trust provisions are not that straight. But I am sure we all are capable. Income applied outside India, that is also not allowed. Now, that Mr. Fogla has in his book given this chart, I have just added for the benefit of the participants. Only first item is red because it is really in red shape. There is no clarity on that matter. So be careful about that. Others, where 30% is applicable. Now, one more thing. These 2-3 budgets, they have brought similarity in all the provisions. 1023C and section 11 provisions, they brought at par. They have defined what is a specified income. You have not to see here and there. Only those are will be taxed at 30%. Specified violations are also brought at one place. So that is there. But others which will be applicable as AOP and maximum marginal rate 115 TD. So these are the provisions where different tax will be applicable. Only point number one, there is no clarity. Now that is all about inter-charity donations. Any question on inter-charity donations, please? Whether I have not been understood or the things are very clear. I don't think things are that clear. Yes, please. You have studied the law. Come on, get up. PBI.
So I wanted to ask you that what do you mean by benefit to the concerned persons? Well, to which you are talking about. So, sir, for example, there is a trust which avails actually there is a purchase which is done from the trustee. Suppose the trustee is having a firm as well, which deals in certain products. Say that this is the benefit which is the trustee is getting.
That is not falling under direct, indirect benefit. That is falling under transaction with the persons covered in 13.3. There is a difference. Transactions with the persons covered under 13.3 and benefit transferred to them. Now, benefit transfer, this is not benefit. If he is charging you normal rate for which he is selling, then you are out of the clutches. If trustee has rented 50,000 per month rent, and you are paying to trustee 30,000 rupees, so that is not covered. If trustees are giving services, if you have a college, professor is a trustee and he is giving lectures. Now you pay at the normal rate, no problem. But to them, if you pay more than what is paid to others, so that will be covered. Another benefit, if that trust is running a college and trustees and their relatives, children are studying there, or you are not charging fees to them, or you are not charging normal fees also. So that is benefit to them. And mostly it is happening in hospitals. They take treatment with their families, relatives and all. If concessional rates are given, or if not charged at all, then those are covered under these benefits. So that you have to calculate. Even ITR 7 you have to write. Even now Rule 17 AA, maintenance of books of accounts, which has come. There you have to keep the record, what rate you are paying and why it is reasonable. You have to write and maintain the proof for that. So this maintenance of books of accounts is also very 6-page notification. Even public limited companies are also not have to do so much of exercise. But law is law. So, inter-charity, anything else?
So,
Yeah, please. Where?
one question. So, if you can go to that example slide, the table which. So, in the fourth case, cannot we draw the analogy which you have given in the second one? That again here, I am having only 25 lakhs with me, 15% accumulation, 15. I am left only with 10 lakhs. So, 7.5 will become the income. So, we are taking accumulation.
So total is how much? 32.5.
Yeah. And actual cash which I am having is only 25.
I stand corrected. Even while going through, I realized this also.
Okay.
Because 15 and 17.5 becomes 32. And as such, I have 25 lakhs.
Yes.
So only you can accumulate up to 25 lakhs.
25 lakhs.
Thank you very much. What is your name?
Deepa.
Deep. Thank you. Yes, please. हाँ, उनको माइक दीजिए.
Hello. See, I am a donor. I have given a donation to a college of rupees 1 crore. The college said that I will give you one seat to be one seat recommended by you. I will admit as a thing of that sort, or it will be a free seat for you. Is it a benefit?
No.
No.
See, I tell you one thing. You have just given a seat to be allotted. Now that seat to be allotted, if you are charging premium on that, that is not allowed in the law. That itself is illegal. If it is free seat, and if you are giving that seat to your relative, then there is a benefit passed on to him. You understood, sir?
Yes, sir. Thank you.
Sir, we were together in many RRCs. We have seen you fighting IT cases. Thank you very much for attending. I am delighted to see you here. Thank you, sir. Anything inter-territory litigation which is to be allowed, I think that's a big issue. We'll have to see that. There are other amendments by 21 Act where it says loans and borrowing the same way on the repayment of basis it will be allowed. Excess spending or deficit from 22-23 is not allowed. Explanation 511 has been inserted for that it is not to be allowed. Such a important provisions. You are reversing Supreme Court judgment and bringing that amendment as a matter of explanation. From day one, I am saying, you don't have courage to bring a section. This is the way amendments are been brought in. Even explanation 4, you should have brought separate sections. Anyhow, we have to leave it. There is an increase in the limit of 1023C ADA and AE. ADA and AE says if any school, college, or any hospital have got gross receipts. Earlier it was 1 lakh, then automatic they will get exemption under AE for education, one is for medical. So earlier that limit was 1 crore. Now that limit is increased to 5 crores. But only difference is earlier it was project wise. Now it is quad trust. If their gross receipts are less than 5 crores, straight, forget about 11, 12, you just claim 1023C, AD or AE. So that limit is increased. Now, other amendment, exemption to the trust institution is available income tax, only 2 regimes. Now they have divided 1023C one regime and 11 another regime for easy understanding. For them, I believe. Amendment in provisions related to accumulation of income 1023C trust brought at par with 11.2. So those provisions of conditions have been brought at par in 1023C as well as 11, and there were wording under 11 after 5 years. 1023C was saying that it is to be spent in 5 years. There was no any form prescribed earlier. So that record was to be maintained by the organization who are claiming 1023C, and they have to spend within 5 years for the objects for which that institution is set up. Like our Institute of Chartered Accountants, Institute of Actuaries, Institute of Cost Accountant. There are so many institutes have been. So there are even approvals also been taken by many other organizations. So they were to spend in 5 years, but 11.2 was saying, means that the provision was in 11.3, that if it is spent in the 6th year, it was allowed. The wordings were preceding the year in which 5 years are over. But now they have brought in the line of 1023C, now that is to be spent in 5 years. That wordings of 6 years have been deleted. Utilization of accumulation fund spent in 5 years. Application of income to be allowed on payment basis. Section 11.7 has been introduced with effect from assessment year 22-23. That application of income henceforth will be allowed only on payment basis. Whatever method of accounting you are following is not to be seen, and you will be allowed application only on the basis of payments. So that care is to be taken while computing. Our accounting method, most of them are following mercantile system of accounting. So you prepare, income you want, you just record. But there is a reason. Many people are doing big provisions and claiming as application, but we're not spending for many years. So now it is on the payment basis. You continue to, this is my advice, but you continue to maintain your books of account as it is mercantile system of accounting. And while computing the income, you add back those provisions. Or provision which is not allowed, you add it. Or earlier you have paid from next year. That you, on the basis of payment, you claim it. And we know earlier we used to do for depreciation, add back. As for income tax, as for Companies Act and all that, the same way. But if there are big difference, so that big difference will affect first year. Because if you have paid in next year, then you will get in the next year. Deduction will be allowed. We have proposed that bring at par with section 43B. If it is paid before the filing of return, allow it. But there is no corresponding amendment. Now, another important chapter, that is cancellation of registration or approval in certain circumstances. Subsection 4 and 5 of section 12 AB of Finance Act 22 with effect from 1/4/22 have substituted subsection 4 and 5. Now there, as per substituted subsection 12 AB 4 and 5 and section 1023C, where the registration or provisional registration has been granted to a trust or institution. Now we are all are aware now registration and regular registration. So you have to keep in mind 4 types of registrations. But some are beneficial. Provisional was to some extent it was beneficial, even without activity, because there was a lot of litigation, whether which is called activities of the trust when it has started. So these litigations are over now. So there are 3 conditions they have mentioned. Number 1, occurrence of one or more specified violation. If there is occurrence of specified violation or has received a reference for cancellation from assessing officer under section 143(3) that we will see just now, or such case has been selected in accordance with the risk management strategy of the CBDT. This is a new wordings and area they have got in their hand. So whatever they are not able to cover anywhere, they can cover here. Anyway, whatever manner they are doing. Now, has received a reference for a cancellation from assessing officer. If any assessing officer comes across any specified violation, he shall refer that matter to CIT exemption for cancellation. There is no wording may, he shall, means he has to refer. Then CIT will decide after calling the details and informations whether that cancellation is to be done or whether that recommendation is to be accepted and cancel the registration or not. That CIT will decide. That ITO has no power to decide. He can only refer the matter to CIT or principal CIT as the case may be. In certain places, state principal CIT. In Bombay, it is CIT exemption is there. So now what is specified violation? So all violations they have brought together. So any of the violation is occurred when you will face cancellation proceedings or even cancellation. Income has been applied other than for the objects of the trust. Very clear. If non-objects, if you have spent, which I said earlier, income has been applied other than objects of the trust. The objects which is mentioned on your trust deed, you should spend only for those objects, even though that's a charitable object. Earlier, there are so many case laws, even High Court have also referred, even if that activity is charitable, should be allowed. But this provision says No, it is to be spent only for the objects of the trust. The trust or institution has income from profit and gains of business. We know 11.4 and 4A permits business undertaking, which is received as a donation from anybody, that trust can continue. Their assessment will be done separately. Assessing officer may allow, disallow, and that income will be taken as the income of the trust. That's a procedural aspect. And 11.4A, where if the object or that nature of business is incidental to the object of the trust, and separate books of accounts maintained. There are only two conditions. So if you default any of these two conditions, then that is also a special violation. Now, separate books of accounts means separate bank account, separate balance sheet, separate income expenditure account, separate transactions. So don't mix with your normal that we are maintaining a ledger account. So I just want to clear here, separate books of account means total separate. Income applied for the benefit of any particular religious community or caste. If any income is applied by the trust for a specific or a particular religious community or caste. So caste also goes with religious. Certain officers are interpreting this English in such a manner, only community should be religious. Caste is any caste. So that goes in the light of religious community or caste. And there is explanation added, which is created for the benefit of any trust, which is created for the benefit of scheduled tribe and ST, BC, or women and children are not covered. If the beneficiaries are those people, then it is not covered. That is special exemption is given to them. Any activity being carried on by the trust or institution which is not genuine and not carried out in the accordance with all or any of the conditions subject to which the registration was granted. Your activities should be genuine in nature, and whatever conditions they have mentioned in that registration certificate, you have to follow that conditions. There was a big issue earlier when this new provisions for registration came. Whoever applied by May 22, they all got their certificates as a provisional registration. But the section means the clause section and 5 years period were rightly written. And there also period of provisional registration was mentioned in column number 6, that registration certificate and list of conditions. And those conditions, at least 4 conditions out of that were out of or beyond Act and rules. So DGIT CPC thought he can put any conditions, so he put whatever he thought. But then big representations were made to CBDT, even from department also representation were made, because there was one more condition. Any asset you have purchased, you have to intimate to the assessing officer. Now in a hospital, every week, every day, they purchase instruments. Achha, assets means not immovable assets. Assets. So movable is also covered. So how long? And we ask Commissioner, what are you going to do with these intimations? So we don't know. So this is a situation, but CBDT has solved this problem by issuing a circular 11 of 2022, wherein they have said all the registration which has been given for 5 years and with the under the proper clause and section, that is to be treated as order of registration. And all 4 different situations, they have withdrawn all those conditions, and they have with that circular notified new conditions. So whoever has got this type of registration or they face this problem, please keep the copy of circular 11 with that file. Because at least for 5 years that circular will be required. Because whenever you give to a donor or somebody provisional registration, then you will have to give that circular as well. The application referred to in clause AC 12A 1AC new section has been added with the 12A with the new provisions, is not complete or contain false or incorrect information. This has been added with Finance Act 23. If whether for re-registration, for provisional registration, for regular registration, or for renewal, or if you have changed the object within 30 days, we have to get re-registration of the trust. You must be aware of that provision. And there in the application form, you give not complete or it contains false or incorrect information. That is considered as a specified violation and you will face cancellation proceeding. See to what extent they are tightening the provisions. It was new provisions were brought in from 1/4/21. It was extended because of Corona to 31st March, and we all applied whatever information we were having, whether correct or wrong, that is gone, and we got the re-registration. Now, to those cases, if you have given any incomplete or false or incorrect information, that trust will face that proceeding, cancellation proceedings. So henceforth, if you are applying for your client, be sure whatever you are writing is correct. Don't write any information which is false or which you feel is not correct or incomplete. Do not upload that form. You correct it. Now, another problem the trusts are going to face, because there was a requirement to mention yes or no, whether a clause of irrevocability is there in the trust deed or not, because that was a hot problem at that time. And the answer was yes or no. So you had no any other choice. Earlier, when we were writing no, applications were accepted and re-registration came. But after 3 or 4 months, I think after 4 months, then they have corrected that utility. And if you were writing no, then the form was not proceeding further. So people have written yes and went ahead with the registration application. So those will be covered here. Now for this, my humble advice to all of you, whatever trust client you have, check their trust deed. If that clause, if it is really not there, go and amend your trust deed. At least before going for renewal, after 4 means you have to file 6 months before the 5 years. That is after 4.5 years. So at least your trust deed contains that clause. So you can say it was new, something penalty or this can be considered. You see that trust deed and you go to and not only that, Income Tax Department for registration or from provisional to re-registration or normal registration, they are asking the change reports. If there is changes in trusteeship, they are asking bring the latest change reports. So why it is complicated? Compliance has gone multifold. You have to see that all the requirements are done in time and fulfilled properly. Otherwise, responsibilities are going to come on us. They are looking with the big eyes to the chartered accountants. Even one message I received, I think Dilip Bhai also knows it, that if they are asking the SSE, who has filed your return, give him name, address, and whether you have given all the proofs which is they have filled up, whether that is correct or not. So they will inquire with chartered accountant as well. So this is a situation. This will be applicable for all SSEs, not the trust only. There is one more concept Income Tax Department has started. That's why I have mentioned here the time limit for passing cancellation order. So the power before expiry of period of 6 months from the end of the quarter in which the first notice is issued. Earlier, we know that from the end of the month, you calculate from the next month. So from end of the year, then you have to calculate that way. But here, where the first notice is sent, from the end of that quarter, this 6-month time will start. So this is a new concept. That's why I brought to your notice. Then AO shall send the reference that we have seen 143.3. There is amendment. He has to send the reference to that. And one more amendment is there in 143.3. If he send any reference to the commissioner or principal commissioner for cancellation, the limitation of period for assessment will be enhanced to that period. Time barring, suppose it is getting on 31st of December or 31st of March, till that order is not passed, that limitation period for assessment will be extended, so that he can give the effect on that assessment. So that is another amendment in 143.3. Now in cancellation, any question? Thank you. You gave me the time.
Say one trust is accumulating under 11.2 for 5 years.
Hmm.
They are not able to spend the amount in 5 years. And in the 6th year, they are adding into their income tax return and paying tax on that. This is happening since last 4-5 years. Whether this will amount to specified violation.
Yes, now it is specified violation. You have to pay 30% of that. Even you cannot reaccumulate.
That is okay, but what about the cancellation risk?
That is falling under specified income.
Okay.
Cancellation is for specified violation.
So that not spending in 5 years is not a violation.
It is not violation, means cancellation provision you will not face.
Okay.
But here also, see, specified, they have covered specified violation. Now, specified violation says income applied other objects, not business, then applied for religious purposes, then for a particular religious community, not genuine, not for the objects, not complied with the requirement of. One more point I missed, I just covered just now. So that will fall under specified income. And you have to pay straight 30% of it. It will not be considered on the normal rates. Even normal rates also about 10 lakhs, it is 30%.
See, the education institutions like college, etc., are giving their halls for marriage functions, etc., and not maintaining separate books of accounts.
You are supposed to maintain.
But that is not
No,
a.
but you are treating as a business.
No.
If you are treating as a business, then separate books of accounts are required to be. If it is within 20% of, that is the basic limit for not applicability of section 215. But now read Auda case, Ahmedabad Development Authority, which Supreme Court has given along with new noble education. That is for 1023C. This is only on interpretation of section proviso to 215.
Okay.
See, our judiciary took 12 years to interpret one provision. Proviso to section 215, Supreme Court interpreted after 12 years. So there they have now changed the concept. Nature of activity is not to be considered. The profitability is to be seen. If it is cost plus reasonable markup, then no 215, proviso to 215 will not apply. So now reasonableness, what is markup? There are certain more issues. So those judgments, I think that already the time is over. I have started 15 minutes late, so I can take 15 minutes with the permission. But I tell you, 215, now you read, everybody should read, whether if you are handling education or trust, or where there is a business 215, proviso 215 applicable, there's two judgments to be read. Or listen somebody when there is a lecture on that topic. Already so many people have said that the only issue was there is interpretation of proviso to 215, which they have now coupled with the income earned, not nature of if rent is there and the expenses are more than that, or your rent is, if you can prove that it is less than what is the normal rate and you are charging less than that, then proviso 215 will not apply at all. So it is 100% on the basis of that Ahmedabad Development Authority in Ouda, it is called. Then one section they have added, section 1310. It's a beneficial section, and it has created some relief to the people. There are three conditions under which, if you have defaulted, that is, one is applicability of proviso to 215. Then in case not getting the accounts audited in time and not filing the report of 10B and 10BB. Second, third is not filing of return under 139(4)(a), wherein the trusts are required to file the return, under allowed 139(1) or 139(4). So in 2023 amendments, they have now covered belated returns as well. Now trust can file belated returns, but their forms are to be filed in time. From 9 and 10 has to be filed before the due date of filing of return. So for any reason you are unable to file the return, you can file up to December. Now time barring is December only. In October is the time, only 2 months. November, December you get. Anyhow, but this is a beneficial provision. But in these three cases, if your assessment is done, then certain all expenses are to be allowed which is spent other than capital expenditure, and amount incurred in India for the objects of the trust. Means the amount is spent on the object of the trust is also to be allowed before computing the taxable income. So suppose you have not filed 10B or 10B filed, CPC now will not disallow 100% on your gross receipt, they will not tax. So this is a beneficial project where in these three conditions, certain expenses will be allowed, but certain conditions also they have put. Such expenses should not be from the corpus, such should not form loans and borrowings. The claim of depreciation, if it is 11.6 allowable, then only 11.6 says if you are immovable, that capital expenditure, if you have cleared application of income, will not be allowed depreciation on those assets. Then such expenditure is not from the contribution or donation to any other person. Then the provisions of 48 TDS and the cash payments will be allowed. No expenditure allowance or set off for losses. Also, no deduction in respect of any expenditure allowance set off for losses. Yani, those things will not be considered while giving the deduction. But mainly establishment expenses and amount spent on the object of the trust. There are only mainly two expenses incurred by the trust. And those both will be allowed except capital expenditure and some other disallowances. That's it. So it's a beneficial project, welcome project, provision. Now there is one very bad provision, that is penalty for passing on unreasonable benefit to trustees or specified person. Section 271 AAE is added with effect from assessment year 23-24. So if during the any proceedings, mind the wordings, during any proceedings, he just come to know from somebody and got that oral information, and that he cannot do that. If during any proceeding under this act, it is found that trust or institution has violated provisions of 21st proviso to 1023C or 13(1)(c). 13(1)(c) talks about direct or indirect benefit to the trustees. Trustees and persons covered in 13(3). Directly or indirectly benefit for the persons covered in 13(3). In such a case, AO may levy the penalty. If it is found in the first year, then 100% of that amount. And if it is found subsequently the same violation continues or found again, it is not that continue, even found again in the second year, then 200% of that amount will be penalty. So trustees, their relatives, now be more careful that it should not be passed on any direct or indirect benefit to them. Now there is one more amendment that is with effect from 21-22. Any donations received by temple, mosque, gurudwara, church, or other places notified under ATG 2B. ATG 2B notifies so many trusts or organization which are covered under that section, and they get 100% deduction to the donor. So here the wordings, mind it, temple, mosque, gurudwara, church, or any other. I think it seems to be error in the drafting of the provision. It should be for those temple, mosque, gurudwara, or church notified under ATG 25, donations received for renovation or repair at its option to be treated as corpus donation. Any donation received by this as of now, or word is there, means those are also covered and normal also covered. But I foresee in the next budget, this will be corrected. Because their intention is very clear. It is openly for Ram Mandir. We can understand. No, for all the corners, money is receiving. Even they have no idea who has sent. But anonymous donations are not covered to religious trusts. That is one benefit. They can, at their option, they can treat that donation as a corpus donation and is spent as per the provisions applicable to corpus donations. And in case of default in any year thereafter, if they have not utilized that money, then that will be treated as income of that year. This is a provision for this type of trust. Then Finance Act 23, we have covered corpus and loans and borrowings. Now there was an amendment that Form 9A and 10 where or will accordingly apply for 23-24 subsequent year at least 2 months prior to the date of filing of return. Means August was the date given for filing of accumulation. Now you see the 31st March closing, April, May TDS returns up to 31st May from 10 BD, the donation return is to be filed. Then thereafter, get the accounts audited, and by August you file the accumulations forms. Then in September you file the audit report, and October you file the return. So activities keep aside and do this thing only. No, but see what they are expecting from us. But this provision of filing of 2 months is corresponding amendment in section 13(9) is not done. Like 12(1) we have seen earlier. Here also 12(11)(2) in 13(9) it says it is to be filed before filing of return 139(1). So there is contradiction in both the provisions. But CBCD has issued a circular 6 on 24th of May. I think you all are aware of that circular. Therein they have said, because before filing the audit report or before completing your accounts, how can you calculate your accumulated figure? It is not practical. So they have clarified this situation and corrected this position. Now that 9A and Form 10 can be filed before the due date of filing of return. They have not written along with the return. 31st October is the last date for that. Because now return can be filed belated up to December. So there is another flaw. That is updated returns. You cannot file after belated. So there is a provision for previous 2 years, updated return can be filed. Now,
CPs, no, for the earlier assessment.
no, earlier, this is provision from 23, 24. So now they have given, okay, you can file. Earlier, it was not there. Earlier, all the provisions, even section 12 was saying you have to file the return in time. Otherwise, you will lose the exemption. There are circulars to grant you condonation for 10B, 10, 9A, filing of return. Those powers are still delegated to CIT. You can go for that. But initially, it's wrong. They will add CPC. And then you fight, stay and appeal and condonation and all those things. But with this circular, they have said now 9A and 10 can be filed along with the due date of filing of return. So it will not be considered delay or accumulation will not be denied. So they have corrected the situation by issuing that circular 6, because circular 6 has also granted certain dates which were missed by the trust for re-registration, for provisional registration, because within 6 months from the commencement of activity, many people miss that date and they applied 10AB for regular registration late. And CIT was cancelling that because that application was in time. So now they have corrected that it is extended to 31st of September. So whoever has missed those dates or whoever has already applied and filed late, they can take benefit of this circular. Now there was a provision, section 12A2, which was up to 22, 23. That any trust is getting registration in any year on the day of registration, if his earlier returns are pending before any proceeding before AO on the day of registration, then those trusts will get exemption of 11 they can claim. So just to bring those old trusts who had not registered themselves, to bring them to the income tax net, they were allowed that earlier income also will be getting exemption under 11. But the condition they have put is pending before AO on the day of registration. Now, whether pending before CIT appeal is also considered before AO, because the assessment is not complete. So there are so many high court judgments, even IT case laws, which says even if that assessment is pending before CIT appeal, means first appeal, then it is extension of assessment by AO and it is pending before assessing officer is to be considered. So there are case laws, but you have to fight for that. One provision I missed, I think I should cover. Not for cancellation, sorry. Not because this is also important provision. Not complied with the requirement of any other law which are material for the purpose of achieving its objects. And the order, direction, decree by whatever name called, holding that such non-compliance has occurred and not reached to finality. If you have not complied with the requirements of any other law, so there are two situations. There are different wordings are used for registration and for cancellation. For registration, he has to just see whether you have complied or not. If he finds you have not complied any other law, then he will not grant you registration. But for cancellation, unless it is reached to finality, he cannot act upon that. But very important wordings are there, which many people are missing. Please understand that, which are material for the purpose of achieving its object. If those compliances are not material, so that is not to be considered. A simple thing, you have not filed your account with the Charity Commissioner office. It doesn't make any difference to your objective. Even I say, change report is also not filed. But you have appointed in the, how long we can continue? Over or 10 minutes more? No. I think we will cover, but let us cover this. So, for example, you want to start a school and you have not taken permission from the municipal and you have started school. So that is a default which is material for the purpose of achieving your objects. You want to start a medical center and you have not taken license from municipal to run that nursing home or medical center. So that is material for the purpose of achieving your objects. So you decide the matter which is not material for the purpose of achieving your object, that is not covered. I have been told to cover, but one last point I will cover that is also very important. 10B is not possible, though it is mentioned there in 1.5 hours. ये भी नहीं हो रहा है. So 10B itself requires a separate discussion, and I will advise WIRC to have study circle meeting on that instead of lecture. Because lecture, I am saying my view, I am discussing, you are listening. But in study circle, threadbare you are discuss. So that those points are very clear. 46 points. How many? 22 are annexures. 10B. But only thing is 10B is applicable for 5 crores or more total income. They use the word total income. Now, total income for the trust we have to see. 5 crores or any FCRA received or any outside India activities are done, then 5 crore limit, or for all other trusts, 10BB form. 10BB is smaller than the 10B, but that is also complicated, not easy. That not possible to cover. I will just cover 115 TD. This is decoded provision, which says if you make any default, then the trust has to pay the tax on accredited income. And what is accredited income is defined? Market value of the assets minus liability. That balance amount, you have to pay the tax at 30%. And earlier 150 TD was saying only cancellation was covered. Now from assessment year, I think it is 24, 25. No, it is 23, 24, 24, 25 with renewal and certain funds को निकाल दिया. That's a different political issue. So 3 more conditions they have put. You have not filed re-registration in 22. That form 10A, if you have not submitted or your trust has not obtained re-registration. Second, if you have taken provisional registration and within the given time, you have not applied for regular registration. Or at the time of renewal, after 4.5 years, if you have not applied, that situation is also covered 115 TD. So cancellation and these 3 situations, now there are 4 situations trust has to face. So please don't miss that renewal applications. Otherwise 115 TD will apply. If the trust is having immovable property, then gone. Their market value minus liability, what liability trust can have? Nominal, negligible. So on the difference, you have to pay 30%. So be careful about applicability of 100 TD. So they say, do charity with open heart and close your eyes. Follow the compliances. And now days are coming. We will be sued. If there is a big liability has been created, we chartered accountant who has submitted that audit report, we have signed that report, so we can be sued for that. So please, now onwards, don't do anything wrong. And not only that, we are covered under PMLA. NGOs are also covered under Prevention of Money Laundering Act. Chartered accountants, company secretary, and ICWA, cost accountant. They are covered if you are part of it. Or you have created that trust. It has come from shell companies. So if you have created the trust for that purpose, the person who has created will be under PMLA. Or you have helped them in converting or money laundering matters. then you are in trouble. No bail, straight arrest. So don't indulge yourself in such activities. Be straight. Let the trust face whatever. Do your professional duties as per the law. Thank you very much, friends. I think I have taken a little longer. I am sorry I could not cover many things. But one thing I tell you, while going, people have started living good. That please do some charity. I have suggested, really, I'm telling something else. I have seen many people are doing. 3 or 4 chartered accountants are coming together, forming a trust. They are transferring their income, say 2%, 3%, 5% of your gross receipts, and they are doing charity on that. I think I suggest that to all of you, and I offer my free services for such formation of trust. And you have any difficulty, my email ID is there at the end. You can contact me or you can send me a mail. I can reply at my convenience, but I will reply to you. Thank you very much.
I think it was sheer pleasure to listen to you, with Vipin sir. I think it was an excellent discussion. Can we have a huge round of applause for Vipin sir on the entire amendments that we said? Thank you so much. I also recognize the presence of CA Ketan Sayya sir, our treasurer for WRC. And let's not forget the tomorrow's session, the third day of DTRC, is from 2 to 5 p.m. and not 5 to 8. So please be there at 2 p.m. Thank you so much for this amazing session. And thank you so much, everyone. Thank you.